Start recording. Okay, so first things first. Let's open the spreadsheet. Oh wow, we got 16. No. How many we got? 12. 12 entries. Hit the limit. More than hit the limit. And good. Cool. So we are gonna go through them and see what I think. See what we all think. Apologize in advance because I'm going to be very low energy because I have been dying of what I assume is a sinus infection for like 3 or 4 days now. So my voice is shot and I feel like garbage. But the show must go on. Okay, so we got author, symphony name, link. Take that. Copy that all over. Cool. And we're gonna do this. We are gonna split screen it. Have my biggest criteria. We got simplicity, originality, help if I could spell. What else do I care about? Simplicity. Wow, I really can't spell. Simplicity, originality, length of backtest, I guess. Would I run it? Cool. All right. 4 criteria. That's what we're going to be working with tonight. All right. First things first. We got Rogan, max backtest. Okay. There we go. Broke something. (6/1, 2015). Oh, goes parabolic during COVID. No surprise there. Cumulative return. Apple, Amazon, Generac, AMD, URI. What is URI? United Rentals. Oh, okay, it's like construction equipment. FCX. Franco. Freeport McMoran was close. NVIDIA. Okay, so basket of high beta companies across 4 different sectors. 3. Tech. Basically tech. Generators. Chips. Resources / mining and equipment, and then we got leveraged indexes. Okay, so we're just dip buying. Interesting. Okay, so we're buying the top indexes when the RSI of SPY is under 30. Okay, so we're buying things that are trending up. I can see it. I can see it. How often does that really happen, though? Where, like, how often does that really happen, do you think? Where the 10-day cumulative return of SH, which should be, yeah. Wait.
Max, are you sharing your screen? I don't see anything. Unless it's just me.
Am I? Nope, no, I'm not. Completely forgot to do that. Screens, capture device, screens, screen one, screen one. There we go. Thank you. Okay. So where was I? Yeah. All right. So we got the very confusing if the market is going down check, and then we buy the highest performing things out of the baskets when the market is going down. Well, then if we are above the 30, we could just go to a different dip buy. Okay. Same baskets, same thing. And finally, if there are no dips to be buying, and we are below the 200-day, we select the top out of various inverse and anti-beta SDS. Yeah. 1x, 2x, 2 BTOLs, and a bill. I wonder how that basket actually plays out. I wonder how often we just end up entirely negative or entirely neutral. Because that seems like way more likely of a thing to happen than like -1 and bill or something like that. Okay, so that's all when the market's going down. We buy the top trending things when the markets are going down. I'm assuming to mitigate downside, which it looks like it does with an 18.3% max drawdown over, what was that, 6 years? 7 years?
Testing, testing.
8 years.
Hey, Vox.
Hypercase.
You are not sharing the right screen.
No?
So yeah, we just see the your browser as a tiny little
Interesting.
window. Yeah.
Alright. How about now?
That works.
Okay.
Thanks.
Cool. Alright. Like I said, in my defense, I'm barely a functioning human right now at this moment. So, apologies for the technical difficulties. Okay. So, that's our dip buy section. I don't hate the companies chosen because, like, Freeport and Generac aren't going anywhere. Neither are Apple and Amazon. Like, they're probably going to exist for the next 100 years. Pretty safe guess. Indexes, anti-beta. That is all anti-beta in short. Yes. Okay. So we got Trends. Okay, so 30-day RSI is greater than the 40-day, 45-day RSI. Normal market. Dip buy, dip buy. I don't know. Overbought, 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 overbought. Okay. Makes sense. I don't like that. I wouldn't run it, but it's logical. It makes sense. Bear oil. And this is all in the context of, yeah, market going up. Okay. 10-day RSI of TLT is greater than 10-day RSI of SPY. So bonds are up faster than equities, or bonds up, equities down, but not negative yet. Top trending TVX. What is TVX? Inverse 7 to 10 year. Okay. TLT, IF, BTOL, SHIV. Equities over bonds. Okay. That's commodities, not equities. I can dig it though. Makes sense. It's okay. All right. So the other thing I actually just noticed is everything is over. Oh, we got 5 days. Okay, 5 days. I can live with 5 days. But everything is like top 2, bottom 2, 5-day, 10-day. I can dig it. What's the else we're in? Else. Okay, so if the market's going up, but there's no... But the short-term trend is not stronger than the long-term trend? Or the shorter-term trend is not stronger than the short-term trend? 10-day RSI, less than 30. Okay, so it's the same kind of oversold. Yeah, oversold, oversold. Anti-beta, yeah, okay. Yeah, solid. Alright, good entry. I like it. Where is it? This is, like, I think this is the first time I've seen one of these. Like a 30 versus a 45-day RSI. I don't think I've seen one of those yet. The web thing? What web thing? Rogan, what web thing?
Oh, I don't even know if you can hear me. Just the chat.
Yeah, no, it's just right here. Or the thread. Either or. Doesn't matter. That's up to you.
Cool.
I think this is the most unique thing that I've seen in the whole thing. 30, the RSI, like, I can't remember what the proper word is for it, but like comparing the two different RSI lengths for like divergence between the two of them. That's clever. I want to see just how well that one part works, though. So here's what we're going to do. We're going to come over here, and I'm going to sign in Composer, where you guys aren't watching the screen.
Wow, this one's like literally parabolic. God damn. What's the the comparing your eyes? How do you actually pull it up?
Okay. What do we want to compare it to? Because, like, you are absolutely right. It is completely and totally parabolic compared to Spy, which
How does it compare to like just a standard TQQQ, like literally the stocks or SOXL? That's an example.
oh, good question. About like that. Hammers the shit out of it.
Damn.
Yeah, so we got a max drawdown of 18.3 compared to 81 or 90, depending on the exact index you want to look at.
But even in the last like 3 months, where like TQQ has been ripping for like the last 3 months, SOXL especially.
Yeah. Oh, trailing 1 month. Well, the Symphony loses to both of them, trailing 1 month and 3 month. By like a lot. So like trailing 3 month on the Symphony. Oh no, 3 month on the Symphony is fine. 3 month on the Symphony is 44. 3 month on TQQQ is 42, and Zoxel's 71. So. Nope. Here's what we're gonna have to do then. Close it. Reopen it. And edit. You piece of shit. That's frustrating. I'm already signed in. I've never dealt with a website that gives me such issues to signing in. Mountains or hills, and then I gotta go through these fucking captchas. Because, like, I am actually just a robot and I can't tell what's what. Okay. Edit. There we go. Leave. Okay. So, the thing that I want to see is just that part. Paste. Yeah. 100% AR. That's crazy. That's wild. That's not right. %400 over 3 years. Kind of wild. Oh, no, I had to sneeze again. And it's on threshold rather than daily. 77.6. Okay. That's funny. It works better as threshold than it does daily, but so even without the
So the interesting thing about this one is you guys saw the dip that like the 1 day dip that happened because of OPEX on the 20th. This literally avoided it. Not only did it avoid it, it actually went up like what is it 2% somehow. So I would give it bonus points to somehow avoid that out of sample. Whereas if you compare that, like literally the last 7 days on TQQQ, you see a dip on basically everything. So I'm curious to see how the heck did it avoid that. to be honest. Like that little micro avoidance was a full on anti beta. Just that one day. Like you would expect trend followers to also suffer that. So I'm not sure if this is. I want to sort of understand what the
Like
it's too bad that the author isn't online. He could probably explain it better.
I mean, he is though.
Oh,
He's literally in the call.
oh. Why is he not explaining any of this?
Rogan.
Oh, I'm just listening to you
Yeah.
guys. I thought this was more you critiquing.
I mean, me sitting up here and shit talking strategies for the next 2 hours is going to be kind of boring. You guys are more than welcome to talk. Okay, so do you know off the top of your head what part of this triggered on Friday? I don't expect you to actually know that.
I don't.
Okay.
I should probably pull my laptop up.
Okay. So let's see. Just for reference, we are talking about the 22nd, right? That's when OPEX was.
Let me double check it, but I thought going off of memory it was the 20th, but I'll double check it right now.
Yeah, OPEX was Friday, but if you're talking about the little flash crash thing, was Wednesday.
That was the 20th. Yeah, that was Wednesday. Yeah. Well, apparently the rotation happened on Wednesday because the OPEX is usually Thursdays. So the night, like literally, like what is it, 15 minutes before close or something? People were moving money in and out, right? And the volume was relatively decent that day. Yeah, but that was a Wednesday, December 20th.
Oh yeah, okay. So yeah, Tuesday went up like 6%. Okay, so what was it holding? Alright, I gotta go over.
Was something in overbought? Was it just holding like VIXI or?
Probably. It's a very, very good guess. Let's see, 20th, it was holding 50% IEF, 50% TLT. Oh no, it's 100% VIXI on the 19th.
Yeah.
And then on the 20th, it got out of VIXI and into bonds. Which.
Okay, there's a dumb question. Is that how it works? Like if it's on the 19th on there, it's holding it for the 20th? Or is it?
If you're looking at the dates, it should be that's what you're holding for that whole day. Yeah, it doesn't include the close, obviously.
Wait, so what did I just say? Because Hassan's right. Whatever I just said, he's correct. Ignore what I said. But I think how the chart, and like the chart is the point that it ends at that day. So, yeah, no, okay, so that would mean that IEF and TLT went up 6%? That doesn't sound right.
It's because VIXI jumped 7% like during that 10-minute window.
Yeah. But it wasn't holding VIXI on the 20th.
Yeah, it happened during after hours as well. So it switched out. I think what's on the 19th?
Yeah, so IEF only jumped 0.5%. You're right, Vox. So the algo shows the returns. Oh no, it was 50% IEF. What was the other 50%? Sorry?
TLT.
TLT.
Yep.
TLT. On the 20th, rose about 0.7%. So we're looking at about a 0.6 or 0.55 mixture gain.
So that is not going to make the strategy go from 9.32 to 15.94?
Interesting.
So-
So what was the next day? What did it hold the next day?
So the holdings. See, so what I think probably happened is it probably bought Vixie at like. Actually, I don't even know. I'm not even going to try and pretend that I have any idea what happened. It was holding Vixie at end of day on the 19th, and then it went to 50-50 IEF TLT.
Yeah, I guess that's a question. I mean, honestly, I've never really liked the charts, even when you. I don't know if they line up right. I'm wondering if it's selected on the 20th, the IEF and TLT, and on the 19th. I don't actually know. Does it? Because
Yeah.
it
I don't
TLT and
know.
IEF didn't go up. There's
No.
honestly so one of it can't line up right. It had to have been in Vixie. It's the only thing that was up that much. If it
Let's
was,
see.
Yeah, so that is the only way
Vixie-
that this logically makes sense.
Yeah. So then that means I'm wrong. So that means really that on the 19th, it's what is really being held on the 20th. So
Right.
technically speaking, composers screwed up this graph. They
What
should
it-
really.
What it shows what it shows as the holdings is what it bought that night.
I think that's okay.
It's the-
That
it's
makes
the
a lot of
easiest-
sense.
It's the easiest way to explain it.
Yep.
Yeah, so like
I think
what
that
it-
makes a lot of sense.
So that means that it bought 99% of the portfolio, or whatever was assigned to this symphony, into Vixie. And then you got the whole 20th worth of move on the Vixie, which, for reference,
So it went into Vixie on the 12th, actually. So it's been going into Vixie ever since there was a breakout in QQQ.
for the 13th into the 19th. So from here, you guys can see TradingView now, right?
Yes.
Okay, cool. All right. So this means that from here to here, it was in Vixie the whole time.
Damn, it literally caught that bounce like maybe a day, like
Eh.
maybe plus or minus a day.
A day early. It got the bounce a day
Yeah.
early, but
You got to give it some points for that.
do I? I mean,
Well, I mean, how
should.
are you rating it? How are you rating it? Because regardless of what the algorithm was, the ends to me sort of justify, like, okay, like it actually did do something smart.
Well, sure, but like I care more about its ability to keep doing smart things over the course of the next 10 years than how well it did last week.
Absolutely. So how can you rate that? What's a good way to rate it? But that's certainly one micro test. You could say that it did pass.
I mean, I guess I'm not.
What about maybe looking at the quant stats? Have you looked into the quant stats?
Nope, not at all, not yet. I mean, like, gonna be completely honest, don't really give a shit about stats on symphonies. Like,
What's your main thing?
how well I think the reasoning behind it is going to hold up. I'm not a quant. Like, I'm like an old school. Like, does this actually make sense from a
Intuition.
what's the word? We got quantitative and
Intuition?
well,
Yeah, basically.
so it was.
Fundamentals is the only.
No, but like the reason that I like this one is because it actually checks all of my boxes. Yes, discretionary. Thank you. It actually checks all of my boxes. Like, there's no like 1 or 2 day mean reversions, so I can like be reasonably sure that this is going to match the backtest. It's not using like very obscure, very small. Well, drip isn't the highest volume thing in the world, but like I don't have to worry about this not trading because it's got really small tickers in it. Let's see. I mean, apart from the mean reversions, which are basically just mean reversions, there's really no way to innovate on them. Like the comparison of the
Wow,
two,
this
comparison of the
does
two
really
RSIs.
well. Yeah, and it does pretty well from 2015. Yeah.
Yeah, it does. So like the only thing that I would actually change about this is I would probably not give it the ability to go 100% Vixie ever, because like I just don't want to do that. And I'd probably replace these two with whatever I end up doing here. So like, I don't know, 50-50 Vixie Bill, or like 33% Vixie Bill B-Tall or something like that. And then just copy paste that down all four of these groups. But that's just a personal preference thing, which is the entire grading basis of this whole contest. Like, half of it is literally whether Jason or I would run this. And I have, at this point, much lower standards than Jason does. I will run way more things than he will. Which I never thought I would ever say. But, yeah, okay, so...
I'm also shocked to hear that.
Yeah, you're talking about the new Jason, not the Jason from 6 months ago.
Right, exactly. I'm not talking about Jason that would run 10 different versions of Beta Ballers and call it a diversified portfolio. I'm not talking about that Jason. I'm talking about the Jason now that says there's only 10 tickers that you should be trading and anything else is excessive. Like, that's a little...
Wow.
Yeah.
I gotta sync up with Jason.
Yeah, everything he does now is
Conservative, or
that's one way to put it.
Yeah.
why did he get burned? Did he get
Well,
burned?
he's been burned so many times. So he got burned by the Alpaca outage. He got burned by the Apex
Ugh.
outage. He got burned by
Visay,
Yeah.
being Visay.
yeah Visa, and because Yahoo keeps screwing with the Y Finance library
Would
that it
Vox
relies
run
on.
it? Yes, Vox would run it. Length of back test. Scale of 1 to 10. What does this go back to? Like 2015, 2017, I think I got it to.
Yeah, it goes June of 2015. I looked at, so I always look at the 2015 crab walk because
That's fair. This doesn't... Oh, this does go that far. What the fuck? I could have sworn this didn't go back that far. Anyway, 2015. Let's see. All of 2015.
So the flash crash?
Was that in August? I could have sworn that was in like October or March or something.
It was August 21st.
Oh,
Or
then yes,
24th.
that is the flash crash.
August 24th.
It brought it from up 4% to down 12. Wow. Okay, so it ate shit on the flash crash, but it's really hard to find anything at fault for that. Because honestly, if you manage to dodge that perfectly with no damage, I'd probably tell you you're overfitting it. So I'd be more worried about something that didn't dodge that. Or did dodge that. But over the course of the next like year, it proceeded to plus 39. Yeah, I'll take it. That's solid. Length of back test. Let's go with a 7, I guess. 8, because I can't. 7, yeah, because I can't take it back to like 2008, 7, which would be ideal. I don't actually think I could take this even if I changed all the 3x leverage stuff, but yeah, it's fine. Simplicity. Let's condense this a little bit and see what we're working with. One, 2, 3, 4 if else's. 2. 6, and a 6. Woodfox run at originality. I mean, that's relatively simple. It's just like a bunch of dip buy baskets, and then just trend following.
Yeah, there really wasn't a lot of. The only thing I was trying to do was see if I could use the sort of medium or longer RSI lengths
Yeah.
instead of like whatever moving averages or
Yeah.
just a different sort of long term sort of trend.
I mean, that was the entire goal. So
Yeah.
I think it worked. And that's the one that like half the strategy hedges on, and it performs basically just as well if you like. No. Copy that. Balls. There we go. New symphony. Paste. Run. What do we go back to? 6/1/2015. 6/1/2015 to yesterday. Then we got 90 AR, 18.2 max drawdown. 99 AR, 18.3 max drawdown.
You know, I never even ran it that way. So funny.
So the whole top of the symphony adds
A little.
9% AR. Well, now that means I gotta see what this does with just the top of the symphony. So we're gonna copy that. Paste that. And we're gonna delete that. That's it. Bill. Perfect. Well, that certainly does stuff.
Yeah, I mean it was right. I've
35.8.
kind of liked or played around with that sort of 10-day cumulative return below zero, kind of going into sort of a black swan style catcher. It's kind of the, I don't know, the circuit breaker that I use on a few that I've liked, that I'm like, that I kind of like that idea of, I don't know.
Yeah,
It's almost, it's a circuit breaker. It's kind of the only way I can think of it.
yeah, it makes sense. It's very interesting how it just seems to like grind downwards a little bit, and then like then it does the dip by thing and just goes right back up.
Mm-hmm.
Flat, up, flat, up, flat, up, down, flat.
Yeah, it does the dip by or it's anti-beta short, right?
Yeah.
So it's really only, you know, I'm kind of like, it's a fairly simple way I'm looking at it of, okay, if the 10-day returns are negative zero, if we're way oversold, dip by. If not, just stay sort of whatever,
Neutral.
anti-beta short. Yeah. Because the other,
like
you know, in the other part of this was, again, I was kind of trying to think like, you know, you can be above or below a 200-day moving average or 50 or 20, but I kind of wanted to look at some different ways to, I don't know,
Do
flip
something
from
similar.
sort of bullish to bearish or neutral or whatever.
Makes
And
sense to me.
I kind of liked them.
No, it's definitely an interesting take on a way to get similar results, but not using not using the same thing necessarily. Because like it is going to like it's going to give you different results than even like a very short EMA over a slightly longer term moving average. Like it's going to give you different results from that, just because cumulative returns responds to every up and down in the process. I forgot to set it to daily again. That doesn't really change anything, surprisingly. Oh yeah, it does. It stops the grinding down a lot, actually. That does change stuff. I mean, okay, so like both parts of this.
Vox, are you planning to give each of these strategies? Oops, sorry, is that a question? Are you planning to give each of these strategies like a rating, like 1 through whatever, 10?
Yep.
Or is it just going to be one winner, sort of?
Well, I mean, in the end, it's going to be one winner because like somebody has to win the money.
Yeah.
But like, I'm going through it. Jason has, I believe, already gone through it. It's 2 days before Christmas, family things.
Yep.
So yeah, at some point in the next few days, he's going to, like, me and him are going to like talk about it and see what we agree on and what we don't. And then if like we can't somehow come to an agreement on something, then we're gonna call like, I don't know, Garen or Derek or somebody who hasn't entered something in this. Maybe Brian? Did Brian enter something? No.
Nope.
Didn't. Okay, so like all three. Anyone who will answer. Using a spreadsheet, I might as well act like it. What the fuck did I just do? There we go. Okay. Cool. Alright. Grand total of 33 out of maximum 50? Would I run it? Yes. Because, like, it's really funny. I will put money into basically anything to test it, so long as it doesn't seem completely impossible. And that does not seem completely impossible. I haven't actually like asked Jason which ones of these he finds interesting or compelling. So that's going to be a very fun conversation because I feel like it's going to be a very small number. Okay, leave setup. Beat all to the metal. Okay, what do we got? 42.1 AR, 18.8 max drawdown. Current price of TLT is greater than 150-day moving average of TLT. 5-day RSI is greater than 5-day RSI of BTOL. Okay, so if bonds are trending up and short-term bonds are moving up more than a market-neutral index, interesting. Okay. By the highest RSI.
Well, I mean, just, I don't know, point of clarification, right? BTOL is actually short high beta, long low beta, right? It's constructed, like it ends up being market, whatever, slightly inverse the market because it's essentially, it is like the portfolio short high beta, long low beta. which gives it its kind of slightly inverse, whatever, zero beta, market neutral. So we're really talking 5-day RSI of
Yeah.
TLT is greater than whatever, right? This
5-day
is a
RSI of a
short high
ETF.
Yeah. I'm trying to think through because I've never really thought about, I've never seen I've never seen a comparison to that fund. And I'm trying to think okay, it's short high beta, long low beta, and bonds are outperforming something that is slightly inverse, call it high risk equities. So is that really, I guess in that sense, it's just bonds are stronger than inverse high beta models.
Has some extremely long drawdowns.
Yes. Yes, it does.
Basically, from the end of 2014 until the middle of 2016. Basically all of 2021. Almost all of 2017. Almost all of 2022.
Or is this just BTAL?
Yeah, this is
Yeah,
just
yeah.
SPY versus BTAL.
Mhm.
Yeah.
I'm trying to see whether
Yep.
it's actually even a market inverse fund or not. Because I'm going to be honest, I've never actually looked at that.
Not exactly, right?
No, it's not. You're
because
right.
it's also rotating between sectors, right? If low beta starts outperforming relative to high beta, you're going to see BTL moving up, but it could be moving up with the market
Mm-hmm.
because it's a relative, value fund between, high and low beta just being inverse. So if anything, it's almost like call it a canary in the coal mine, right? If it starts moving up with the market, that's kind of a strange indication that low beta is outperforming inverse high beta.
Interesting. My very smooth brain has a hard time grasping why we would want to do that. Like I'm trying to figure out the why. Like I'm trying to see what the pattern is here that we're trying to exploit. Because when
with TLT relative to that?
Yeah. So when the 5-day RSI of TLT is greater than the 5-day RSI of BTAL, we go. Okay, so I guess what are we picking from? I guess is kind of where we need to start at. Okay, so using the 14-day standard deviation of returns, we take the two highest standard deviation of returns. Why are we doing highest standard deviation of returns? Okay, so inverse high beta, long low beta. That kind of just feels like it would. That's really weird, the idea that it's like inverse high beta, because that's all the stuff at the top of the market. Like it just goes short that. So when the market's going down, this would go up. But when the market's going up, this is going to stay flat because there's a quote unquote flat over a long enough period of time. Because if the top of the market's going up and the bottom of the market is going nowhere, which has happened for the last year straight, what does the fund even do? I don't get it. Like, that's actually, like, now I'm thinking about what the point of BTOL even is. That's a completely
Well, it's
separate.
yeah. I mean, if the market is moving down, right, high beta should underperform low beta.
Should.
Should, right? Should. That's the
The-
theory behind it.
Yeah, but like the last year or so has that maybe it will, maybe it won't. Who
Well,
knows?
most of 23 high beta was outperforming, right?
Right.
Which is why BTOL got barraged.
Mm-hmm. Okay, so we picked the one with the highest drawdown in the last 60 days.
Lowest
Wow.
drawdown.
60 day max draw. Okay, yeah. All right, lowest drawdown in the last 60 days. 20-day moving average of returns, highest one. 30-day moving average returns, bottom one. Bear treasury, bear market. UPRO BTOL. Inverse volatility, bull treasuries, bull market. This is very interesting. This is very interesting. Because, like, this is such an eclectic group of stuff with an eclectic group of indicators. There has to be some kind of pattern here that I am just not seeing.
Is Colin my puts on here? Is he
I don't see
actually,
them.
or she?
I don't see them.
Yeah, I'm curious too.
Right, like I'm not the only one that like I
I like the fact that it's a bunch of different stuff. If you're asking, like, just me personally,
Same.
it's just I can't tell if this is, the interesting thing is just like you're using, they've got different sort of filters, right? Max
Uh-huh.
drawdown, moving average, but it's not on the same basket. It's on, why not use the same filter on, I guess I wonder if you could, like, I'd almost be curious. I'd be very interested in actually, like, charting out those four groups relative to each other. Like, what are they doing? Are they correlated? Are they not correlated?
Okay, so when you take those four groups with no other, just those four groups with no other filters, it doesn't really do a whole lot. Like it loosely follows the market and then goes down more than the market.
Oh, just taking the 14 standard deviation top two?
Yep. Yes. Like if you just take those pieces and like if you just take these pieces and put them in a symphony with no other filtering on it, it does absolutely nothing.
What is that a fair way to look at it?
No,
if you take the
not.
5 okay.
Absolutely
if you take
not.
the 5-day relative strength of TLT, if then, and then just throw, I don't, what do they have? What is,
yeah, we haven't even gotten past this part yet. So like so actually that's a good point. In the interest of fairness, I'm going to take that, delete that, paste, else. Oh god, what is this else?
The after
inverse volatility, inverse vol, max drawdown, moving average returns. Okay, this, like, I can make sense of this.
That's bond heavy, but what doesn't make sense is why would you, if the RSI, I guess it doesn't matter why, but if the RSI of bonds is greater than the RSI of BTOL, you're going into that 14-day standard deviation group. So this is saying if the 5-day RSI of TLT is less than the call it inverse market.
Yep.
Which means the market's moving up. Equities are moving up. Bonds. Well, yeah. I'm gonna try something. Maybe just to.
Hey, okay, that does a thing.
Get my brain to work.
Like, okay, so I know that I'm completely changing the strategy, but like, I don't know what trend this is picking up. Like, I'm not. Okay, so let's think this through. BTOL is a long low beta, short high beta fund.
Mm-hmm.
But it low does not mean negative, it means 0. So
Correct, right?
with-
it's like consumer staples
right
versus
yeah. It's like Costco versus Nvidia, basically.
yes.
Okay.
It's
So-
short Nvidia, long Costco. That's a good description.
Okay. So if I had to try and put like probably oversimplified logic to this, it's the 5-day RSI of super long-term bonds, which is more tied to like macroeconomic factors than it is to government policy, outperforming an index that goes up when the most short-term interest rate sensitive industries are going down.
Yeah, that's a good way to describe it, right?
Okay.
Bond prices are moving up, which means yields are dropping. But
things that rely on those rates being low are also going down.
yeah,
Okay. That could be a very compelling check. I want to preface what I'm about to say with that in itself is a very compelling thing to be checking. Assuming that's how BTOL actually functions. Full caveat. I dug into what BTOL actually does once, like a year ago. I don't remember what it says anymore. I'm going entirely off of what Rogan's telling me right now.
I'll go to their website real quick again.
If that is what BTOL does, that could be a compelling thing to check. I would not, however, use that check to go into an anti-beta fund or long 20-year bonds. So if I was to do this, actually no, wait, yeah. So in a world where the Yeah, okay. So I would not be doing. I wouldn't be doing a group like this. I would also not be doing that. I feel like we should probably have one group or like one unified basket, like we were saying before. But I would like to see it be a basket of things like utilities, commodities, and the things that BTOL goes long on, like Costco, Kroger, General Mills, Johnson and Johnson. Um, just take the entire consumer staples direct ETF and just
Yeah,
blow
but I
it
don't
out.
know that it. But Fox, this is a true statement, right? So bonds are stronger than BTOL, which means low beta is, well, low beta
In theory.
is underperforming high beta in order for BTOL's relative strength to be, call it, low, and bonds are strengthening. So it's not necessarily,
Oh yeah.
there's so many relative things going on here that I wish they were on to explain this, because I mean, I'm trying to think, like, because it's bonds are stronger than the relative strength of those two components. So you wouldn't
Yeah.
necessarily be wanting to go long. And that's why I was a little confused why you're not going long bonds if TLT is stronger. Like, why wouldn't you flip this around? Like, and maybe you, yeah, um, I'm going to do it.
Let's see what happens. Oh, that's even worse. No, let's not do
So that doesn't work. Okay, so why is, but kind of bizarre. Why are,
like I don't like it's obviously doing something.
yeah,
It's
I'd
like
love
it's
to
like
hear the
it's like
theory.
beta ballers. It's obviously doing something. Like it's not actually just a coin flip. Like it's slightly better than a coin flip. Kind of. Not really. Like it's barely better than a coin flip, but like it's doing something. I just can't tell what. Like okay, so I think I think it's also kind of important that like the context of this is that the current price of TLT is greater than the 150 of TLT.
Mm-hmm.
Because
So you're in a long-term bond bull market,
yep,
call it,
sure,
and the 5-day relative strength is up versus that.
yep,
That's a good point, right? Because the TMF afterburner, that is bullish bonds, right? So it's in a long-term bond bull market. It's
in a long-term bond bull market, it's going to go up. Kind of, because like it's. So you're grabbing the thing that has moved the least over 5 and 14 days between TMF and BTOL, and you're grabbing the bottom one out of a 30-day max drawdown. So bottom means it has the highest max drawdown, right?
no lowest.
Lowest. I don't know why my brain has so much trouble wrapping itself around that. Moving average of returns. That's probably why I've never built anything with max drawdown in it, because it just doesn't make sense in my head.
No, a top max drawdown makes. I was playing around. I'd use that a lot until I realized that it doesn't actually mean low drawdown. It means like what has the highest drawdown in the
Yeah.
last 30 days.
What's spiked down the most?
Yeah, which is a lot like using standard deviation to some extent, right? It's like pick something with the most volatility over the last 20 days.
Yeah, which is a real interesting way to pick things. But, okay. And then we got alternatives, which is... Okay, so if we're not in a long-term bond bull market, we have alternatives. So we pick the top trending 10-day RSI off of BTOL, Bill, an S&P 500 covered call ETF, and a commodity income strategy.
I just ran it. Like if you zero out the top section and just basically look at if you're less than the 150-day average of TLT and just put Bill in the rest, it's 1.6%. So it's essentially flat, right?
So like alternatives is basically just flat.
Yeah.
Interesting.
But when you run the other side of it, it's useful because the 5-day relative strength of TLT with the TMF afterburner without that bond check is pretty volatile by itself.
Sure.
So it's doing a good job of basically eliminating the drawdowns in that top section. Like it's because there's a 61% drawdown in that top section without the bond check.
Huh. I mean, that's a decently respectable just income strategy, I suppose. I don't really know what kind of income you'd actually be getting from it, because like you gotta hold things at very specific times and you're trading it every 10%. But that is intriguing, if nothing else. Eep. So let's see what that is. Hello there.
Oh,
How's it going?
good. In a meeting?
Yeah.
Believe.
Yeah, I know. Oh wow, yeah, there's like really long... There's really long stretches where it literally just sits in Bill. That's interesting. It's actually spent most of 2023 in Bill.
I mean, it's getting most of the returns from that 5-day relative strength of TLT being over BTAL.
Yeah, most of
Like
them.
25, well, in this time frame I'm running, 25% annualized return, I'm just grabbing it, but
Yeah.
versus 33. So most of it is actually coming from those roots, which
Supposed to be a size medium.
That's funny.
I don't think Walmart knows how to size dogs.
I don't think they do. I think you're right. Huh. Okay, so this is extremely unique. I will certainly give it that. This one's gonna get a 10 for originality, because I've never seen Bill or BTOL used in a comparison before.
no, I'd love to hear their thoughts on like the theory. Like what were they thinking when they put that on there? Like
right. And there's no way for it to go into single tickers as far as I can tell. It's like all... Oh, it'll go mostly into BTOL though, which is, I guess, not the worst thing in the world. could be worse. Okay, so we're not giving that. We're not giving it a 10, but we're gonna give it like a 7. Bunch of single companies. No, there's no single companies. Length of back test. I'm gonna be honest. I don't really know how much I even care about the length of the back test because I don't know what it's testing. Because that is.
I mean, it goes back
down the
into
most
2014.
Oh. 11.4. How's it doing 2015?
Not good.
You are not kidding.
What's 2015, by the way? Why are you?
2015 was the market was basically just like flat through all of 2015, and I think that was when I think the Federal Reserve tried hiking rates in 2015.
Yeah.
Tried.
I mean, honestly, I think this is where its max drawdown comes in. Is 2015. Maybe. Have to run it in quant stance to see if there's any other bad years. But that was a bad year. Or bad 9 months, 10 months. Interesting.
I mean, yeah, it was not good. It looks like it bottomed out in like October of 2015, and then it started going back up. But like, it didn't actually match. It didn't actually like start to perform on par with. It didn't actually get. English is hard. It didn't get up to SPY's level again until like June of 2016. So it took its sweet time getting back up, but it did get there eventually. And then over the next like 2 years, it still still underperformed SPY until.
So what wasn't in 2015? Curious if it was, which section was it in?
Alright, so we got TMF, BSOL, TQQQ, TMV. COMT. So it looks like it was in the bottom half. Looks like. Because I don't remember there being COMT in the top half. TMF, BTOL, COMT, XYLD. Yeah, I'm almost positive it was in the bottom half for most of 2015, if not all.
Well, it had TMF and TMV in.
Oh yeah.
It's
there's
got TMV, so it had to have been
TMF at some point. Yeah, it had to be in the top at some point because there's no TMF in the bottom.
or TMV. So yeah, it was in the top section for, which means the 5-day. Well, so I guess bonds are moving up. Market was, or at least, well, I still can't wrap my head around how to think of bonds relative to like
No.
the low beta, high beta thing.
Yeah, that's making my brain hurt a little bit. I'm gonna be honest. I mean, my brain already hurt before I sat down, but that's making it worse. Length of back test. That's a 7. It went back to like 2015. Solid, not terrible. Simplicity.
You know, it's interesting because 2015, another way to look at that, the market's flat, not really going anywhere, generally low standard deviation.
True.
I'd actually, right? So you can see what it was selecting were the bottom two groups there, which was basically getting into TMV, TQQQs, and TMF. It was not going all that often into the top two group. Maybe. I had UPro there and TMV. But it was getting
Like,
interesting.
I really, really want an explanation.
Me too.
I just want answers. Because, like, I can't wrap my head around this. I can't figure it out.
Like why the individual groups were selected and how they relate to that logic, that if then statement. Obviously, it's interesting because, like you said, it works, right? In the sense that it doesn't look, I mean, other than 2015, it looks like it generally just kind of fucked along. And
it looks like it just works. It just chugs along at 4 times the speed of SPY and half the max drawdown. Somehow. I don't know.
But
I can't figure it out. Which is like... Which is the hard part.
Yeah, I mean, if you ignore 2015 and 16 and kind of pull it forward, a couple of years, the max drawdown goes down quite a bit. Standard deviation is low. I mean, it hasn't done anything in the last 3 months, but it's over which, again, why would it? Why wouldn't it be working?
2017.
What is it doing over the last 3 months?
So I think the max drawdown was some point after. You know what? What the fuck am I doing? Quant stats. Why am I doing this? Why am I trying to just look at it and figure it out when I can just...
What's kind of unfortunate is it's been in Treasury bear ETF for the last month, almost all of December. It's because of this is where the standard deviation can kind of bite you, right? It's been 50% Treasury short with an offsetting Treasury long and then T triple Qs, but not enough to make up for the Treasury bear. Right? That's why it's not. Well, and then it was in BTAL,
which also went down.
And Bill, what the hell was it in Bill? Bottom max drop. Where the hell did he even get Bill? So how did it get Bill in the top?
I'm going to be honest, this is probably one of the most unique things that I have ever seen.
Yeah, for sure. I liked it when I saw it. I didn't figure it out then, and I still can't.
You are very lucky that I have blur on this camera right now.
Why?
I gotta put this on YouTube.
Oh, thank fucking God.
Oh my God. So my girlfriend got her coworker an anime body pillow. And I'm not sure if...
No, don't show it.
I'm not going to, because then I can't put it on YouTube, because it's not family friendly.
It's, what anime is it? Darling the Fran? I don't know.
This isn't work for you. This is work for me, Nick. This is a business, sir.
Ma'am, this is a business. This is a place of business.
Like, this is literally my second job.
Sorry.
Why are you sorry? I don't give a shit.
Because I'm over there struggling, trying to get it into the pillow.
Anyway, okay, so yeah, this is gonna get a 10 for originality. I'm gonna give it like a 5 for simplicity, and complexity needs to be a negative. So that's gonna be a -10 because I can't figure out what the fuck's happening.
So I'm looking back at the last 6 months because I'm curious. Like, it got in from like basically the end of June. It's been in the bottom alternatives section,
Okay.
picking the bottom the 14 EMA bottom one.
Mm-hmm.
It's because it's been in BTA and Bill, right? 10-day relative strength top one, because BTAL was underperforming, right? BTL's
Yep.
been getting crushed. I don't know why the covered call ETF and the commodities ETF sucked, but somehow it ended up in BTA and Bill from like the end of June all the way till December, literally 50-50 for like 3 months in those two. And then it flipped
Oh wow.
into short treasury, long treasury, and T triple Qs, which put it up in
The top part, like the bottom two groups, probably, or like mostly the bottom group, and then rotating through the other three.
well, somehow it ended up in 3 tickers, right? How does it get into 3 tickers? Oh, because it's TMF and T triple Q. So it was
Yep.
bottom group and then TMV.
Which is the second from bottom.
Right, which is how it got essentially 50% TMV and then inverse volatility, T triple Qs and TMF.
Yeah. Which is a very
So
interesting place to be.
it is.
Like I'm gonna need an explainer on this one because like I don't.
So, and
I don't
again,
get
it selected TMV because it was a 30-day moving average return bottom one,
Yeah.
right? Which is treasuries have been getting crushed,
Uh-huh.
or treasury shorts have been getting crushed for the last month.
Some
But
treasury
because the
longs are-
standard deviation of the group was high, it got selected and then it
Yes.
chased treasury shorts down.
Uh-huh. Yeah, so like this is actually, now that you put it like that, this is actually a textbook example of the problem with the idea of picking highest standard deviation.
Standard deviation,
Yeah.
right? Because it's chasing treasury shorts down. Now it did good picking the treasury bull and the T triple Qs, because it makes sense, right? On the last month, the Qs have been on a tear,
Yes,
right?
they have.
High standard deviation. So it's getting, and treasuries have been on a tear. So it makes sense that it selected group 4 using standard deviation, and group 3 I don't know why it picked that one. I don't it's just high standard deviation, right?
Yes.
But it got stuck, right? It's
Basically,
kind of,
yeah.
it's giving me PTSD of my lab D or whatever, my yin yang, whatever shit. That went the wrong way on me. That's the problem with chasing like the even mean reversions or bottom, right? You can definitely chase them down.
Mm-hmm.
But interesting. So, okay, so that's what it was doing. It went from the alternatives for like 3 months where it was in BTA and Bill. Over the last 6 months, it was a lot in that bottom because bonds were selling off, right? So TLT was under the 150, bonds were selling off. It went into the alternatives, and it was in BTA and Bill, which is probably why it was fairly flat.
Fairly, yeah, relatively speaking.
Yeah, up until and then it's kind of gotten whipsawed. Interesting. So it performs best. I'm trying to think about, like, even when I'm looking at these, like, what market structure does it perform best in? And we'd have to talk to them who designed this to figure out like the theory.
I'm trying to find when this got posted so I can like see if there was an explanation given with it.
No, there wasn't. I actually went and looked myself
Dang.
because I wanted to see if he wrote anything when he put it on there. He said he was going through a phase.
Okay.
Not sure what the phase was,
I
but
can respect that.
I like it. I like it.
I can respect that. I have questions,
Yeah.
but I can respect it. Okay. All right. So that one is going to get
Interesting.
max downside for some complexity because I can't tell what's happening. Simplicity, I'm actually going to revise that like a little bit lower because like, yeah, can't figure out what's happening. If there is an actual reason for it and they didn't just throw things at the wall and see what worked, it gets a 10 for originality because it's the first time I've ever seen somebody even attempt to use BTOL as
I agree. Yeah.
like an indicator. There's like minimal.
Like comparing.
Yeah, as a comparator, yes. I don't think there's any single ticker days. I don't think.
No.
It's 2 at minimum.
It's interesting because it's really more of a bond-driven symphony, right? I know that they call it BTA, a little whatever to the metal, but it's really bond-driven.
Yeah, that is fair.
Which is one of the
bond BTOL, and those are your
bond relative to BTOL,
right?
Which
exactly.
It's heavily bond-driven.
I have to ask. I have to.
I'm gonna. Okay, I got to think about this one more.
I got to do it. Okay. We're going to go on to the next one. Otherwise, I'm going to spend the rest of my night trying to figure out what's going on there. And I don't want to do that. Wartime strategy with Yieldmax. Alright, October 31st, 2023. We officially have the shortest backtest length so far. 10/31/2023. Hell yeah. Alright. Length of backtest. We're going to give that like let's go with a 2, because I don't know if that could actually get any shorter. Have they come out with any tickers since then? Bunch of single companies. What's this? Oh. Nope, no single companies. Not possible. Okay, so this is realistically about as simple as it could possibly get. It's a 4-day cumulative return, which it's a cumulative return, top 2. if we have live money in this, I'd be very curious to see how accurate that is. I did not realize how many yield max strategies there are now.
Oh yeah, there's a lot. I'm still waiting for some history on these because I feel like they could be very interesting in these symphonies. And it may actually be somewhere where standard deviation could be useful. Like, and I know we can't use it yet because it's just they're all so short. But like, you could use standard deviation to get kind of a measure of like implied volatility, which should increase your option premium that they're selling on these covered. I mean, they're essentially like a bunch of covered call ETFs and various things. So you could use a standard deviation of the underlying to either go long the the Apple whatever yield max ETF or something else. But I feel like they could actually be super useful in the future once we get some more history to them, because you can kind of play off that option value that they're generating.
Yeah. All right, so portfolio components: short put plus long call. Short put. Okay, so they buy a call and a put, and then they sell a call against the call that they bought.
Well, yeah, they're creating a synthetic long position and then selling a call over the top. Right, you're in a call spread and a short put. Is another way to think about it. You're long a call spread, short a put.
Yep.
I mean, it's not even really fair to call it a covered call. you're short a put, long a call spread. Yeah. Because you're not covered anything. You're, covering a synthetic position.
Yeah, you're going balls to the wall.
Which is why it's outperformed. Like some of these are up so much. I actually thought they were doing covered calls, but that's not a covered call. That's a synthetic long position using options, which is probably why they're getting so much leverage in this.
Yeah. I don't know, like, do they go into any more detail about like what are the Greeks of what they're doing? Are they like,
yeah, like what's the delta they're selling? And
yeah, exactly.
I'm assuming they're buying at the market, right? They've got to be going synthetic every day,
right.
Long, and then I'm curious what they're selling from like a delta on the short call.
Right.
I don't know. They probably aren't going to give us that secret sauce, are they?
I doubt it. They're gonna find, but like at the same time, Neos, the people that run like BNDI and SPYI and stuff like that, like the smaller competitors to like QYLD and stuff like that, they literally came into the server and did an interview with us and told us exactly how they like determine their positions. So like some of them will do it, but like that is all covered call stuff. This is not that.
No, it's a higher risk covered whatever synthetic long with a
right synthetic long with downside protection, basically.
No downside protection.
No, yeah, short put. No, it's like it's a synthetic long with like
unlimited upside. Unlimited downside risk, limited upside. Right, and I'm curious if they.
Wow.
I feel like they could get slaughtered in a down market, right? Because it depends on how much leverage they're putting into their synthetic positions, but they are selling the call over the top, which, assuming they were just going 1-to-1, right? No leverage in the ETF relative to the assets. They should actually be slightly outperforming the underlying equity.
In theory.
But in theory. But I mean, you're actually synthetic, so you're I don't even know if that's true because you're going to take decay on your underlying options, but they're daily. Does that even make sense? Is that even right?
Great question. Great question.
Because you have to buy it. They got to close it daily.
Well, it looks like NVDY. I'm just going down the list here, and it looks like the oldest one is like barely even a year old. TSLY. It's like it started December of last year. Meanwhile, AMDY started the end of September of this year. Hence the back test. I don't know. It's
TSLY opened at 18, 1 year from it's 18 to 12 versus what did Tesla do? What's one?
idea.
And Tesla's up, which I mean that's no good. In that TSLY is down 33%. Tesla's up almost 65% in the last year. It's down 30. So TSLY is down 30. Tesla's up 60. So you're underperforming the equities, which is not surprising, right? You're playing with options.
Yeah.
But that's why I'm kind of curious. Like I say, it'll be now if you're playing them relative to each other, which they're doing in this case, right? All of these yield max symphonies are essentially, just comparing them to each other.
Yep.
So not the end of the world, I suppose, that they're underperforming their underlying equities, but yeah, they're just so new.
Yeah.
I mean, you could have
They are very, very new, and like that's kind of the concern with them. But like, I don't know if that's necessarily the fault of the strategy, but like, that is 80% of what the strategy holds, and it selects the top two among cumulative returns over the last 4 days. I'd be very curious to see if this strategy ever collects a dividend. Ever.
Yeah, I was kind of wondering that too. Like, because you're using adjusted prices, super high distribution rates, and how is it accruing them relative to like the X dates and stuff? Like, if you're in one of them, if they're all on the same X date, and I think I actually went and looked this up at one point. Like for these, do they declare a dividend on every single one of the funds on the same date? Because then you're going to be in one of them, at least. It's just the only problem is with it. I mean, there's, I guess, a lot of problems. Maybe this is a question. Do you know how Composer uses adjusted prices for dividends, or right? Because they're accruing a dividend in the adjusted prices, right?
Sounds about right.
But how do they do it on this where are they just taking the last distribution and then I don't know. Okay.
That's a great question. That's a question for the engineers, unfortunately, not me.
Okay.
I don't know.
Are you asking when the dividend gets included or incorporated into the adjusted price?
Yeah. I thought it was like for SPY, for example, I thought it was adjusting it based on 1/30th of the distribute, or one whatever. Like every day it's accumulating in the adjusted price a bit of the distribution. And I don't know if that's right or not. I guess that's a good question for the composers. Because that is something that I would say would be a pretty significant risk with ultra high yielding symbols like this is, right? If, I mean, you just look at some of these yield max distribution rates are 60%, or whatever, 100% on Coinbase on the distribution rate. Like, if that's getting added into the adjusted prices, but then it doesn't, I mean, if they don't actually pay that dividend the next month because they didn't make any income, like, it's a really good
How
question.
exactly are they calculating
Right.
adjusted? Like, what is the actual math behind
Yeah,
adjusted
so
close?
for some tickers, it's relatively straightforward because you know way ahead of time what the distribution is going to be.
Right.
Something like Bill, I mean, it's very predictable.
Mm-hmm.
Even so, we've had issues in the past where different data providers weren't incorporating that, sometimes days after the distribution happened, which would throw off the logic because, I mean, that's a sawtooth wave in the unadjusted form.
Yep.
And if you're getting 100% distributions, any lag in incorporating that into the adjusted price is going to be a problem. But that's a question actually for Exignite because we can't quickly
True.
check that. We can check to see if there's discrepancies between Alpaca and I don't know, Y Finance data or something like that. See if this is something that's issued because it's such a new ticker. I imagine it might be a problem, but also
Fair,
because it's
yes.
so unpredictable.
Yeah. And they distribute monthly, right? Like all of them?
Yeah, I think so.
Yeah, okay.
Yeah.
Interesting. Well,
But they're going to distribute based on whatever they're making on their options, right?
yes. I believe
Or-
so, yes. Distribution schedule. Oh, that's easy. Okay. Declaration date 5/3, X date 5/6, 5/7.
Yeah, I think they're all the
Okay.
same. So you're going to be in one of them on the,
Hmm.
whatever, on the X date. So you will get dividends or distributions or whatever they're
Yes.
in this case. It's just you don't know which one, and I guess that would be the question. Like that, I've been very interested in that, like, and why I haven't really done anything with these is I don't know how that
understand.
works. Right? If you've got 100% distribution rate and it's getting factored into a cumulative return calculation that they may not actually pay it because it didn't generate any option income this month, but it's based off of the last month's distribution rate. I'm not, I just haven't figured out how they actually would add that in, or what are they doing, like how are we getting shown the pricing or whatever.
Yeah. I mean, that's actually two separate questions then. Because, like, I have
Yeah.
questions just about how the ETFs work by themselves, but that's a very good point about how, like, Exignite handles them and the calculations. That's also a very good point. Okay, so let's grade this strategy. It is the strategy itself is like not complex at all. It's very simple. It's literally just 80-20. I don't understand shit about the ETFs in it. But yeah, I don't understand anything about the ETFs in it, but the strategy itself, very simple. Originality, I don't know, it's an 80-20 with a shitload of yield maxes in it.
Now I'm just having to look at yield max. Like, are they leveraged? I mean, you're using synthetic positions,
Mm-hmm.
so I'm very interested. Like, are they leveraging their underlying holding? Like,
I don't think there is any underlying holding.
well, if I give them $1,000 and they're using a synthetic long position, are they using $1,000 in notional value, or are they, levering up my $1,000 on the, on their synthetic, and are they using margin in their synthetic positions, or are they just, going off the notional value of the money that we're giving them?
Well, I mean, according to their in a nutshell, there's no leverage and no stock gets called away.
Yeah, no stock gets called away because they don't own any. So they're basically sitting on a bunch of cash, which they're probably parking in T-bills, earning 5%.
Yeah.
And then using that to essentially backstop their options account. And I'm assuming they're just, trading the notional value of the cash on hand. I wonder if they keep the interest.
I mean, I would if I were them. I would totally keep that.
Or does that have to go into the... What is that even? Okay. Anyways, I digress.
It's like almost there's like no single Oh no, wait, yeah, it is all single companies. So like, yeah, like that is all single companies, and the back test is like not existent, and like it's gonna be like another year or so before I would ever consider actually even touching one of the yield max ETFs. Okay, so that's that. That raises so many questions about yield max in general.
Like I said, I think once you get some time to actually see how they perform, there's probably some very interesting strategies you could use to look at, like I said, standard deviation of like Tesla, over a 10-day period or 30 days to get, because if there's high implied volatility and a bull market, it's probably going to perform really well.
Yeah.
Right?
Yeah, it's like a reasonable assumption that the volatility is going to be to the upside.
Right. But you could even put like, cumulative return of the underlying, right? If it's positive with, high standard deviation, I don't know if you could actually layer those, but in that case, you could build some little circuit breakers that are, and that's why, like I said, I'm very interested in these over the long term, because I think you can use the fact that they're selling, or essentially they're in a call spread on
pretty much,
them. And if there's high implied volatility, they should make more money on that short call.
Well, okay, so that comes down to where the option that they are selling is and how high the spike goes. Because I know it's not actually a covered call fund, but it does have some similarities because its upside is capped. So
Yeah.
it's dependent on like how fast it goes up. So I think like
Well, there's two
Coin
factors.
would probably be a pretty good example of something that over the last like I don't know week and a half since the Fed did their thing, because like Coin has gone pretty much parabolic, hasn't it?
Yeah.
Yeah. Okay. And like they're basically synced up. But like that doesn't make any sense to me because it has a covered call capping its upside.
Yeah, but you're getting paid for the implied volatility. So depending
Yes.
on what the premium is in the option you're selling, I mean, you got two components. Well, you got multiple components, right?
When
In
are
an
they
option.
selling it?
Daily, I think.
Daily? Every day?
Thought so.
Interesting.
I mean, they don't really say, but I
Yeah,
sort of
it's
assumed
true, they
these were
don't.
daily.
Because like it would have to be daily, and that's the only way that this chart would make any sense at all to me. Wow, Coin bottomed out at down 92% in December of Jesus Christ. That's crazy. Wow, Coin was $30 and now it's $180. Huh. That's like a 6x your money for a buy and hold right there. Interesting. Never noticed that. Yeah, it's very interesting. That raises like lots of questions about how those funds work, though. Like, that's very interesting. Okay, on to cautious fund surfing. I've seen that name before. That's okay. Let's see. What we got? 1% standard deviation. Come on. My internet's still working? Yes, okay. Internet's still working. Out of sample January 2023. So you built the strategy like almost a year ago and just put it out now for the contest. Interesting. Okay. I can dig that. 14-day standard deviation, 14-day RSI, 21-day standard deviation, 21 RSI.
Just out of curiosity, does anyone know what a normal standard deviation is over these time frames? Like,
No. Nope.
so like 14-day standard deviation of SPY less than 1%. like, am I doing it right? Like, if I just said, what's the standard? Like, if I just did a 14-day graph of SPY,
Mhm.
and it tells me standard deviation is 10%, is that what this is comparing against? Like, is a
That is a fantastic question.
well, let
So
me look
we
at
are
this.
going to go
So-
to Composer, Resources, Learn.
So because I actually just did a little thing where I deleted everything down to the 14-day 1%, so that I could just do a little learning here for myself to say, okay, so standard deviation right now on the last 14 days is 10%, which means it's selecting,
The else, which is shy.
no, it's in UPRO as of the 20th, which means, so that's why I'm like, is it 1% per day? Like, what? Actually, like, what is
Proteus, help.
1% mean?
Proteus, we have statistics questions.
Yeah, I'm thinking about it. So the way I imagine that it works,
Okay.
and we could plot this out with TradingView, is that you simply have a 14-day look back window,
Mm-hmm.
and yeah, you just calculate the square root of the variance, right?
I don't know how to do that. Standard deviation?
Ye-
Standard
Yeah.
deviation. Huh, okay. Standard def, length, 14. Okay, we're on daily candles, adjusted prices. Huh, okay, so that's interesting.
So that's what I don't understand, because this is, if you just took the 14-day 1%, if the standard deviation of SPY is less than 1%, which in here it would be selecting UPRO, which means it thinks the 14-day standard deviation of SPY is less than 1%, and the 14-day whatever. But just starting with the 14-day standard deviation less than 1% as of, the 20th, right? It's going into that section of logic, and that's what I'm like. So how does that?
But the confusing thing to me is that section hasn't triggered this year.
Well,
So how did we get into UPRO?
it did trigger based on however this is calculating, which means I don't understand how it's calculated.
Right. Actually, no. There's like a bunch of different ways it could get into UPRO. So like.
Well, no. I deleted everything except the 14-day 1%.
Like this block.
Just that one little piece, because I wanted to look at, like, just give me one thing. Like, what is it? How do I? I don't even understand what does it mean.
Do?
Yes. So just looking at that one block, it's going into UPRO right now. It's in UPRO.
Interesting.
Which means it thinks the standard deviation is less than 1%, which I don't understand.
I mean, it might be. It might be this that's calculating it wrong. Potentially. I don't know how to calculate standard deviation of returns.
It's a really simple calculation, though. Like, there's basically one commonly understood way to do it.
Oh, well, that's lame. Normally when you open up the indicator, you can just see the code for how they did it, but not this time. helpful?
Yeah, I don't know.
Source code. There we are. Okay. Input length, standard deviation. Plot.
Yeah, it's just it's a built-in
Yeah.
function.
Yep. Okay. So they're calculated exactly the same way that TradingView does, and I trust that TradingView does it properly. Okay, so we need to go figure out how the fuck calculator or Composer calculates standard deviation, because that doesn't make any sense. Just like right off the bat, this strategy shouldn't be in UPro, and yet it is. Cool. Let's make that one make sense. Okay, so we had a bunch of stacked standard deviation.
Their measurement of standard deviation is annualized. That will affect it.
What?
Or wait, no, wait, yeah. I don't know if they're using that in the indicator.
Proteus. Don't get it. Okay. So, fun surfing.
Let's add a request for Composer to allow us to be able to chart the indicators somehow. So I can actually see why it's doing it.
That'd be nice. Alright, so we got 1.5. I really wish I could edit it so I could start collapsing blocks, but cool. Yeah. There we go. Okay. So we got 3 groups.
So the 1% standard deviation, aside from the last few months, which makes little sense to me, it sat in shy basically from whatever, the end of 21 through mid 23 almost, right? So the 1% standard, which again makes little sense because it now, well, I guess it's looking at, well, isn't that just bizarre, right? If you just looked at the 1% standard deviation, whether it's 14, 21, 28, 35, or 42, this is basically saying it was in shy in all 5 of those groups for a year and a half. So standard deviation was greater than 1% for, it's actually going down. Why the hell is it even going down? Why would it go down?
So I'm gonna be honest, as much as I don't understand standard deviation, I kind of like this, because like it spends an awful lot of time just sitting in bonds doing a whole lot of nothing, and then buying UPro, the more sure that it gets it's going to go up.
Why did it go down? I guess why, if it is sitting in shy from whatever the end of 21 for the better part of a year and a half, why are the returns negative?
So it is 100% shy from the end of December until January, or the end of January, at which point it's 60-40. and then 80-20, and then back to 100% shy before the end of January.
Right. So if you look at it,
that's
even just from
22.
like February 22 to December of 22, it's down whatever, 3% or something, a couple percent. Like, why would it go down if it's in shy?
Because shy is not Bill, I don't believe.
What?
Shy. I think shy actually. No, shy does not actually move. Oh, yeah, it kind of does. Kind of. A little bit. Shy moves way more than Bill. I think.
But in the back test here, it shows negative returns over like a 6-month period.
Yeah, from
just
the
being
beginning
in
of
shy.
22 to
Yeah,
23. Yeah, I mean that makes perfect sense. Pull up a chart.
Because-
pull up a chart of shy. Like,
oh, because it's 1 to 3 year. Bill is what, like a couple months, aren't they? Like,
Bill is 0 month to 2 year, I believe. And like,
okay,
Bill has moved in a like $5 price range for its entire existence, to my knowledge. Like I think Bill moved up like $3 on COVID, and that's it. And then it has
Okay.
moved like not much since then. But like this, so Shy started 2022 at 81.95 on the 3rd of January. By January 3rd, 2023, it was at about 79.
well,
So that's like $2. It's a very, very small percentage move. But if 80% of your symphony is in that, then
if you swap Bill out for Shy, like just again in that 114-day 1% block, you go from 18.1% annualized return over the last 3 years to 19.7.
what's max drawdown do? And standard deviation.
So standard deviation with Bill's 17.4, max drawdown 19.3. Well, it's not going to probably won't impact max drawdown. Standard deviation goes, yeah, whatever. Well, standard deviation is higher with Shy, 17.5 versus 17.3. So standard deviation goes down with Bill, returns go up because you're in a rising interest rate environment,
Right.
and Shy is 1 to 3 years, whereas Bill is 1 to 3 month T-bills. So I would probably think or suggest, if you're ever debating between the two,
Probably go
you
with
want to
that.
make, well, depends on which way interest rates are going. In a falling interest rate environment, you would actually probably want to go with Shy.
Fair point.
You're going to get
Fair point.
better. Yeah. So you'd actually be able to create a little, whatever. Doesn't matter.
So I'm trying to create a really quick test in Google Sheets using the Google Finance data to just quickly plot when the normal standard deviation of SPY is below 1% and when the annualized standard deviation of SPY is below 1%. And I'm almost done here. Except it won't actually run the script. A sec. All
right, so here's a question that I'm going to throw to the crowd. this spends lots of time in a single ticker, but that single ticker is shy. I don't have a problem with that. Should I have a problem with that? Because it's not like you're throwing the whole ticker into UVXY or TQQ. Or,
I don't think so. I mean, you might as well call that cash, as far as I'm concerned.
yeah, for all intents and purposes, yeah.
I mean, there's slightly some duration there because you're in 1 to 3 year bonds, which does carry some risk, but
Right.
whatever. It's basically, I mean, if the point is to truly be in cash, I would probably again say you want to go to bill because
Yeah.
you don't have duration risk.
Fair.
But
You only have rate risk, like
Yeah.
rate return rate.
yeah, you're not going to get that little bit of price movement.
Bunch of single companies. No, there is not a single company in this whole thing. Length of backtest. How long does the backtest go back? 2014. How long? Shy's been around for a long time, hasn't it? Yeah, it has.
All right, that's a quick and dirty solution. But I just posted a link to the spreadsheet.
Well, a little over double the returns and basically the same drawdown. Whee.
What's double the returns?
The strategy versus SPY. Strategy's annualized return is 29 if you bring the backtest back to 2009. And its max drawdown is 36.3 versus SPY is 33.7. Okay.
And what's interesting is it's getting the drawdown from the 2% standard deviation. I was kind of looking at that. Like, again, I don't understand the standard deviation, but the drawdown is coming from, well, the 1% standard deviation has lower returns, lower drawdown. The 2% standard deviation has more significant drawdowns. What? So higher standard deviations, and it's 14-day RSI of SPY less than shy. So 1 to 3 year bonds are outperforming SPY, and it's going long UPRO.
Proteus, I'm gonna be honest, I have no idea what I'm looking at here, dude.
There's a little bit of risk.
Standard deviation.
This is another one of those,
T2 times the square root of 252. Okay, so that's annualized. And that's not annualized.
Yeah, D is the 14-day standard deviation. E is the annualized version. Something strange happens at the end of the data set, so the graph is nonsense.
Yeah, I see that.
Like the very last entry is crap. I don't know why. Again, I haven't put too much thought into this. It was just trying to see if I
Yeah.
could answer the question of Google Finance.
Okay, so do we know which one of these Composer uses? I'm thinking it's column E, right? Like that's the one that's the Composer calculation.
So Composer, their documentation for standard deviation only references really what what they're using when they generate sort of the overall standard deviation that they
Okay.
report in the statistics.
Okay.
I don't know if they're using the annualized in when you do some sort of when you use it as an part of the logic.
Interesting. Okay.
But if we can figure out what day it switched into UPRO, which day the logic made that flip, maybe we can see it in these numbers.
On the 20th,
On the 20th.
well, at least in one of them, that the 1% standard deviation flipped. Well, all of them did on the 20th.
20th was
So-
what? The
December.
Oh,
So,
yeah,
like-
we can't
Like
say
3
much
days
about
ago.
that.
So all of them. So everything was less than 1% on almost on every time period. That just, to me, there's almost no way that makes any sense to me that you could have 14-day, 21-day, 28-day, 35-day, and 42-day time frames all hit less than a 1% standard deviation on the same day.
Yeah. It's definitely suspicious.
Yeah. Yes. I would say highly suspicious that you can somehow have every time frame suddenly trip.
Proteus, have you ever asked in in the beta testers chat? Because I think you're the only one in this conversation right now. Have you ever asked them for the math for how they actually calculate these things?
I have not, at least not recently.
Okay.
Last time we really talked to them about that was with the RSI issue,
Yeah.
where they weren't using the same warm-up period as TradingView. I think EMA was similar.
Yeah, something seems funky here.
Definitely. And this is a question that can only really be answered with them looking at their own data set.
Yeah.
I mean, I've noticed a lot of strange things happening with max drawdown sorts. I guess, well, yeah, standard deviation, but I hadn't noticed this particular problem before. But it's something we really ought to get clarification on. My little spreadsheet might have, I don't know, there might be something wrong with it, but the distribution of values, was there any other time that went active in the past?
Where it went 100% into UPRO?
Yeah.
Yeah. December 1st through the 7th, it did it. And
How far back does your spreadsheet go, Proteus? 2015?
Yeah. I mean, it's in the
So
first column.
It went
can-
100% into UPRO from October 28th, 2018, or 2016, sorry, to November 7th, 2016.
And that sort of lines up with the data here.
on all time frames though, 14-day,
Yeah, yeah, we could add columns for that.
I don't even know how it's possible to have 5 different time frames all trigger at the same time.
Me either. At least not in practice. Like, in theory, it doesn't seem like the most impossible thing in the world because I don't know anything about how the math is calculated. Do you want to go ask them how the math is calculated, or do you want me to do that? Because you actually are going to understand the answer, Proteus. I'm not.
I mean, why don't we just make it a public thing in the general chat?
It's going to get buried and forgotten.
Oh, probably. Yeah, I can ask him in the beta channel.
Mod chat?
Yeah, maybe mod chat. Maybe do it there.
Good idea.
And then we can just copy and paste the response.
Yeah, I like that idea. Mod chat. Actually,
Or we, if we send them a link to the exact sort of a minimal test case to show our confusion.
yeah.
You just send them this symphony.
Yeah.
Or just
yeah.
that one rule, even. Yeah.
Rogan, can you do me a favor? Can you like post the link to the one block that you're messing around with? Just save me the 30 seconds of copying and pasting it.
Mm-hmm.
Thank you. And then I'm just gonna like paste the spreadsheet in there.
I think the numbers in the spreadsheet might be off by one row because I started the calculations in the top row. But yeah, like
so, Beaver, if it was like you are entirely correct. The week did have very big moves, so it would make sense if we were measuring standard deviation over a number higher than like 1.5, I think, assuming the math on the spreadsheet's correct. It would make sense if we were measuring a number higher than like, oh, we're not even looking at this week, never mind. But like, if you just go back like over the last like 2 or 3 months, it's been getting like higher and higher. Like it's consistently over 2 at this point. Whereas if you go back to like 2015, 2016, like it struggles to get over 1. So the idea that we are in a more volatile market than we were in the past seems to be holding true. But the problem is that the checks that we're looking at are supposed to be low standard deviation checks, not high. And that's kind of what's confusing, because we are in a high standard deviation environment, and checks that are saying we aren't are triggering, which is why I'm confused. And I also think that's why Rogan and Proteus are confused too, because it's not supposed to be triggering like that. Or at least I don't think it's supposed to be triggering like that. And trust me, I am not smarter than you on this topic.
I don't know. I think maybe it's just late and we're just
that's
not thinking about it. But yeah, I mean, we can ask Composer for clarification.
That's probably a good idea.
I mean, it's conceivable it could be a data issue on their end.
Well,
our brains could be
running
bad.
another little test here. It's a little helpful to visualize. If you actually replace the bottom part of it with Bill or something, so because Shy is in 2 sections, right? It's in the top and the bottom.
Yeah.
So if you just replace one with Bill, it is actually switching between those 2 sections. Don't change that one. Change the bottom one, because then you'll see the primary logic of the 14-day standard deviation. This is where, and then just like delete the rest, right? Is what I was doing. But that's where you can actually see it switching to Bill. If you go down, like it will select Bill occasionally.
Huh.
So it is something is triggering in there.
Okay, so let's take that, and what are we looking at? November 2nd.
So on November 2nd, it went to Bill, which means standard deviation was greater than 1%. 14-day standard deviation.
Which is completely correct. It has been above 1 since September 6th. And
which
has not gone below 1 since.
At least in this math or whatever.
Right. At least in Proteus's math, which I am inclined to trust, personally.
Well, it's such as, I mean, it's just using the standard deviation calculation.
Right. And like all
yeah.
this really proves is that they aren't using the standard deviation.
Right, they're using
Yeah.
the annualized.
Right. So we need to figure out what they're using. At least I think we need to figure out what they're using, because like I'm not going to be able to make this make sense in my head until I know.
Well, that's just it,
what
right?
they're
One,
using.
I don't know, right? Because the 1%, I'm not sure what that means, and I've actually tried to use standard deviation like this,
Mhm.
and I couldn't figure out. Like I was using 0.1 and 0.5 and
Yeah.
1, and I never got anything to actually. I gave up because I couldn't figure out like what I was actually doing with it.
It's a challenge, yeah.
And maybe I'm not completely an idiot because I still don't know what it's doing now that we're even playing with this, and maybe I'm not totally off here. Something seems weird.
Yeah, no, I don't think you're totally off, because like I don't know what it's supposed to be doing. But okay. So
Oh well,
take this. Threshold daily. Oh, that's an important thing. Daily. I gotta make sure.
Why is it failing to save? Why are you failing to save? Save, please.
You pro shy bill. Okay. Interesting. Okay. Yeah, alright. So we're going to save that. We're going to share. Visible. Anyone with link. Copy. Object.
I can't
paste.
get a symphony to save. Why can't I?
Proteus, what do I need to be asking?
Oh, I know what I can't save.
Let me think about that. I'm also trying to think about whether it matters that Google Finance is using the normal close price and not the adjusted close price. I don't think it really matters for volatility.
Maybe. It's
Like there might be particular days where it would affect the volatility calculations, but the overall sliding window will normally be fine, I think. It should be okay. I mean, roughly.
should.
As for what we should ask them, just clarification on how it's actually being calculated.
Well, standard deviation on a low dividend, if dividends are factored into adjusted price, a low dividend won't most likely impact standard deviation. Something like yield max, on the other hand,
Right, that would.
really impact standard deviation if it's.
But in this case, we're just looking at SPY.
Yeah. In this case, no, I think you're right. I don't think that's going to impact standard deviation, whether it's in or out, relative to adjusted or unadjusted.
Right.
Not materially enough, anyways.
That's fair. I could agree with that. Oh, it's this strategy. I remember you guys talking about this one. Uh-huh. That's a very clever name, too. Class warfare. That's funny. I like that. Okay. You can advance question along the engineers for us. To clarify how exactly standard deviation is calculated on your
when it's being used inside of logic. I mean, and they probably get confused by the question because the answer is, well, duh. I mean, it's just standard deviation. But
Okay.
the confusion's coming from we're not sure why certain things are triggering when they are. And you can send them a link to the spreadsheet, although just note that it's not meant to be perfect. It was just quickly thrown together. Oh, no. It hasn't been rigorously examined or anything. Let me get rid of that stupid plot. Like, if they could give us the values that they were using over this recent period where we see this trigger, that would probably answer a lot of questions.
Okay. Well, it's sent. You should be able to. You should be able to see it, Rodius.
Yeah.
Okay. Okay. So, on to the next strategy. Class warfare. Significantly easier. Alright, 10-day standard deviation of return of T-Mobile is greater than the 10-day standard deviation of return of AT&T. So if T-Mobile is going up or down faster than AT&T, we go into a equal weighted basket of Google, Meta, Walmart, and TQQQ. If AT&T is moving faster, we go into Apple, Target, AMD, and UDOW. Now, I remember the conversation around this basically being a conversation about what companies move faster, or not what companies move faster, but like what companies are what companies are for poor people and what companies are for rich people, and we're going to use phone carriers as the determining factor, which I thought was an incredibly tenuous connection, but completely and totally genius from a like conceptual standpoint. Yes, answer.
Is Mint Mobile for poor people?
Mint Mobile is for poor people, but I don't believe it's a publicly traded company.
Damn.
That would be actually a better representative than T-Mobile, because I use T-Mobile
Yeah.
and I resent being called poor, even though it's accurate.
T-Mobile's
Yeah, when T-Mobile bought Sprint, I had to switch over to T-Mobile, and it was hilarious going into the store because on their map of coverage, there's actually just a black space for where Nebraska is. Like they cover the rest of the country, but then there's just like this emptiness in the center.
But wouldn't you need to distill this, like in theory? All right, let's just go with that logic. If T-Mobile is outperforming, well, shit. It's not even. Again, we're using standard deviation. We're not even talking about outperformance. We're talking about volatility.
It's literally just moving more.
Volatility.
Yes.
Yeah.
Right.
One way or the other. Like, it's very clever. It's a very clever idea.
Yeah, but why?
Why? I'm pretty sure the reason why was actually just for the lulls.
Yeah, but why would volatility between two stocks, regardless of who owns the products?
Well, consider the fact that in either case, no matter what the actual switch does, it's going to buy generally profitable things.
Yes.
I mean, the sketchiest thing on the list is TQQQ.
Or Ultra Dow?
Or
I
Ultra
would
Dow,
actually
yeah.
say UDAO is the sketchiest thing on this list, like without question, actually. So
I was just thinking in terms of volatility and max drawdown. I figured.
and just
TQQQ would be.
general connection to everything else on the
Oh.
list too.
I mean, yeah, the idea is more hilarious than
It is.
comprehensible.
Okay, so that is
Like, if
is
this
the
went
original
straight-
comment on it, on like how the strategy is supposed to work, and it actually makes more sense because the way that he says it is that it's like younger / lower income people, which is at least partially accurate. It is mostly younger people using T-Mobile. AT&T is nothing against my older friends, but it is mostly boomers. Like, you guys are the ones that use AT&T. Shut up. You're the exception. Pipe down.
You're
If
still
you-
limited just by region, though. It has. I mean,
But if you take both these groups and just equal weight them, the annualized return is almost 32% over. I don't know how I ended up on it, January 4th, 16 through December 23. But over that time frame, the returns, it's 32% for an equal weighted of all 8 of these
Mm-hmm.
versus the using the signal. So, and again, I don't know what that. The Sharpe ratio is about the same.
Uh-huh.
Standard deviation is actually lower if you just equal weight them. Max drawdown is higher, but that's where I'm like, I'm not sure the signal itself is telling us anything.
can we flip the contents of the else branch to just build to see when it's turning on?
Mm-hmm. When I actually basically put Bill in each section and alternated, if you put Bill in the bottom section and then just use the top section, it's getting 19.8% returns over that period for me.
Yep.
Versus you flip it around and run Bill in the top or something. It gets 10%. So if T-Mobile is more volatile than AT&T, well, less volatile. Okay, now let me just hold on a sec. I just actually am curious. If I just paste that bottom group all by itself,
You know what
it
I wanna
makes
see?
just the bottom group makes 36.7% in my little time frame. Like, the signal actually lowers the returns of the bottom section. Like, if you just run it against, if the standard deviation of T-Mobile is less than AT&T, you actually make the returns worse on that bottom group. What if I just run the top section by itself? Is 25%. Is this even? Okay. So it. What the what?
I don't know
It
if you
makes both returns worse. Like each section is worse off using the signal that's triggering it. Does that make sense? Does it, like if you said
yeah, that
It-
That's kind of what we would
it-
expect, right? If it's hilarious but not real.
right, yeah. No, like if it's a hilarious signal but not actually real, like it would actually just make things worse off in the long run. But like it's I don't know, maybe I did this slightly differently than you did, but like I'm coming up with all 8 of them equally weighted as 31.7
You're not quite doing
AR.
all 8 equal weighted, though. You're having 2 groups of 4 equally weighted.
Yes.
Is that not?
It's not the same thing.
2 groups of 4 equal weighted. The signal does increase the returns by a couple percent relative to just running both groups of 4 equal weighted. And it does lower the max drawdown because the like one section can I don't know how.
Are you sure that it's different, Proteus? Are you positive that it's different? Because this doesn't say that it's different. It says that it's still 12.5% to each
Yeah,
one.
all right, yeah. I think I'm wrong.
I'm gonna have to savor that because I've never been right over you in a numbers thing ever.
I'm sure you have.
Okay.
It's not how I was thinking about it in my head, but
So just the last 3 years, if you just run these all 8 of them, you only get a 14% return over the last 3 years running them all. So versus 32 by using the signal, which okay, interesting. But wouldn't you want to use like cumulative? Let me just
That actually makes it worse. Like a lot worse.
to use cumulative return.
Yes.
Mm-hmm.
It makes it a lot worse.
It sure does. So,
Like you'd be better off holding spy, kind of worse.
yeah. You know I digress for a minute, but T-Mobile versus AT&T, T-Mobile is smaller by a lot, right?
yeah.
Are they?
So, like from like a enterprise value market cap standpoint, so
180 billion.
yeah, T-Mobile
Yeah.
versus good old Ma Bell.
AT&T is 118 billion. T-Mobile's bigger by about $70 billion.
T-Mobile is bigger than AT&T.
US. Yes. Okay. So
That's surprising.
AT&T current market cap 118.33 billion. T-Mobile current market cap is 180 billion. According to FinViz. FinViz can be wrong, but according to FinViz,
Does it give you an enterprise value by chance? I'm wondering if one is more levered. Like
possible.
Because I guess the little rabbit hole I'm going down here is, are you getting? I mean, they're not even if you're only talking, one is twice the size,
like 50% ish.
Yeah. Does it have a leverage ratio? Do you have a debt to leverage ratio on here? Quick. Oh yeah, debt to equity 1.76 on go. Can you go to AT&T real quick? So okay. I'm trying to think, like, is one of them more levered, so maybe it's more sensitive to interest rates, or are you getting, like, why
They're about
is
the
the
same.
volatility? I know, like, why would the volatility or standard deviation of returns of one versus the other mean anything?
Well, so like the price to free cash flow in AT&T is pretty solid at like a 7.39. T-Mobile's like 28.
Okay, so T-Mobile is trading at a far higher multiple.
Yes, in like basically every respect, except price to expected growth. Price earnings
Okay.
growth. Sorry.
So it's going to be more interest rate sensitive, right?
Reasonable. It is in more debt. Yes, I believe. Yeah.
And they're
it's-
both-
Or
they're
it's in
just
more
levered,
debt.
right? Like, so just
Sure.
in terms of valuation multiples, right? If it's higher multiple,
Right.
just risk-free rate. So more sensitive to interest rates than AT&T.
Yes.
So still doesn't mean anything. Standard deviation of returns is still like doesn't.
No, it doesn't. You're absolutely right. Like
mean
it doesn't
anything.
actually mean anything in this context. Hold on. I gotta look at the chat again because I feel like
Well, if the chart didn't happen to go up and to the right, we wouldn't be talking about this.
that's fair. That's a good point. The chart does also happen to go up and to the right, but like oh, okay. So I do remember this conversation. Yeah, so he like basically just went off of the people, like the old people that he plays golf with, and they all use AT&T. And that's the entire logic behind it.
I get. I think where I'm hung up is actually on does standard deviation of returns of two comparing the standard deviation of returns of two equities mean anything
It
other
can.
than
It can. I don't know if it does in this context, but it's like it's reasonable that it could mean something. Like if two companies that are like not inversely correlated, but like let's take it back to BTOL. Like if Costco is moving faster than Nvidia, first off, that's weird. Second off, something very strange is happening. I actually don't know what market forces could be happening that would make Costco move faster than Nvidia.
That actually happened in 2020. With the
not
COVID crash.
Interesting.
retail, right, relative to like stay-at-home tech, but it's not necessarily directional though. It's volatility, right? It's not direction of movement, it's deviation of returns.
Yes.
So
which is like an entire separate thing. I don't know.
See, because I can understand using standard deviation of returns, like if there's a high standard deviation of returns, right? It's implying choppy to some extent.
Yes.
Right. So using just the standard deviation of returns against like a SPY, you could, you know, as a signal that like the market's choppy, go into like whatever, you know, something stable. Try not to get whipsawed. But comparing standard deviation choppiness of two companies
that are otherwise not correlated, which I think is like a fairly key thing in all this, because there's like not there is so there's actually a surprising amount of correlation here, but there's also points in which there is absolutely no correlation.
Well, they're also in very different markets. I mean, AT&T has a bunch of media. I mean, they have Time Warner, and they're doing things other than telecommunications.
Do they really?
I think so. I might be completely misremembering.
I don't know. Might be, might not be. Honestly, I don't know. I don't pay attention to companies like this. Interesting. So the most interesting thing to come out of this conversation to me was not even the strategy. Because I actually thought of a much better way to accomplish exactly the same thing. So if you close, if you go to the strategy and edit it, 10-day standard deviation return of T-Mobile. Okay, so T-Mobile's the youth one. Of target is greater than 10-day of Walmart, except it's not standard deviation, it's moving average of returns. Moving average returns. I want to see. That is worse. Never mind. Fuck. Because, like. Can I have one of mine? Please?
Which one?
The fruit ones.
Hmm?
No, the fruit ones off the floor.
Yeah, no, which one?
I don't know. Surprise me. Yeah, because he posted I requested a comparison between Target and Walmart. Oh, thank you. And, like, I was surprised the amount of correlation there is between the two of them. Target just goes straight down the entire time, and Walmart goes up mostly. It stays flat, if nothing else.
Yeah.
So I kind of figured there'd be something slightly more comprehensible to this, because I can't find anything comprehensible in the T-Mobile versus.
Well, I mean, Target's just had a shitty run of. They don't know how to run a business over the last couple of years. They just manage to step in at every chance they get, which I think is driving it. Because if you just look at 23, so what are we saying that? So T-Mobile, in that case, right? Like, why couldn't you use anything that? I was actually just playing around. Could you use Walmart and Target, right? If does the logic hold?
That was exactly my thought. Can you use Target and Walmart? So, you can't. I tried. It doesn't really work for some reason. I don't know why, but probably because what you were saying, there's things unrelated to the economy that are making Target just shit the bed.
Yeah.
There's very little other way to phrase it. They are just shitting the bed every chance that they get.
Okay.
The other very interesting thing about this chart, which kind of shows me that cumulative returns over any kind of extended time frame is going to be more or less useless. If you like zoom this chart out and go back to like, what is that, 2013? AT&T is up 30%. since 2013. Whereas T-Mobile is up 1,600%.
But again, it isn't looking at returns.
No,
although,
it isn't. I know.
Well,
So
now,
yeah,
here-
you're right. There's not a whole lot of reason to be doing this.
here another one. I mean, because if you just said 10-day standard deviation of T-Mobile greater than 10-day standard deviation of AT&T, and just picked T-Mobile and AT&T, you just don't. I mean, you actually over the last 3 years just get the S&P returns with actually some strange negative drawdown going on in 21.
Interesting.
And I don't know that it actually makes any sense that you would use the companies you're comparing against each other, because it's not like it works for T-Mobile and AT&T. Like if you just use them, just them.
Mm-hmm. How long does this back test go? I feel like I at least need to do this fairly. 2016.
Yeah. I'm gonna do something else here.
2014.
And it's not like you have to use symbols that you're comparing against each other. I mean, you could compare two things. I mean, AT&T over the last 3 years is down 5%.
Yes.
T-Mobile is up 18%. And just comparing standard deviation against each other and selecting, higher standard deviation go into T-Mobile, it outperforms both
Interesting.
by selecting essentially the greater standard deviation outperforms both their respective tickers, although it underperformed in an upmarket. Underperformed both, and then it
That's so interesting.
performed in the down and choppy.
Because, like, I'm convinced that there is a way to do this that, like, actually makes sense. There has to be. There has to be a way to do this that actually makes sense.
Yeah. I mean, I certainly get comparing like two companies that have very different market segments, right? You're
Yeah.
creating a trigger based off of like a wealth divide or something.
Yeah, exactly. Like, Dollar General versus Target might be, like, a better...
But what's interesting, I mean, I guess, but that was the theory he was using, right? Was that Apple's the rich person, Google is the poor person, which I don't know that I don't know how Google fits into the poor person camp. Be like Yellow Pages or something.
Actually, I have an idea here. Okay, so what if rather than trying to use companies, we use the same thing, and just use an index? Let's go with, okay, so the top one is supposed to be the 10-day standard deviation is greater than, okay, so...
It would be like consumer
Yellow
staple.
Gold. Yeah, exactly. It'd be like XLK. No, that's tech.
Wait.
XLF? No, that's financials. Fuck. What is it?
XLP is staples.
Yes, thank you. There's too many. I can't remember all of them. And then XL... What do you think? Tech? XLK?
Yeah.
Okay.
No, we didn't go anywhere.
Nope. Well, that was worse. XLU. Utilities. Huh. XLU?
You could do discretionary
Okay.
XLY, right? So basically, are people only buying staples, or are they discretionary spending? That does a whole lot of nothing. Okay. Anyways. I mean, in that case, though, you'd be using you.
Hey, that did a thing. It is not better, and it's not good, but it's a thing. So when the 10-day standard deviation of returns of XLY is greater than the 10-day standard deviation of XLP, you still underperform SPY. How's the max drawdown? Is the max drawdown worse? Yeah, the max drawdown is worse. Okay. So, 25th of June 2020. You're 100% in XLY for a whole long time in 2020. Actually, all in XLY. Interesting. Okay. And then we hit XLP in August. Huh. Okay. So, like, I am going to go out on a limb here and say that there is not actually a signal that this is picking up. It was in XLY for literally all of 2022. Interesting. And most of 2023. Okay. Run. 26. Interesting. Okay, so that's basically flat.
Okay.
Interesting. Well, okay. So I feel like I've spent enough time on this one strategy. It's interesting.
Yeah, I think I get really hung up on standard deviation of return as a signal because I don't understand what it's telling me.
In this situation, I don't think it's actually telling us anything. I think it's just noise, if I'm being, like, completely honest. I don't think there's actually a signal there. It's a really clever idea, and I want to play around with, like, the idea that like
Class warfare.
yeah, like I want to play around
Literally.
with something that's kind of the same idea, but there's like a I don't know. I don't think it's really like a super common indicator, but like there's a couple
Mhm.
papers about it, and Brian made a strategy with XLK versus XLU, like technology versus utilities, and it's pretty solid. Like it actually works. Like you outperform SPY if you like if you buy into tech when tech is outperforming utilities, and then buy into utilities when they're outperforming tech. Like it actually works.
Yeah, it's risk on, risk off.
Exactly. But like it's basically the same idea.
It is. Although, yes.
It's kind of the same idea. But like this exact situation is basically just, this is what my rich old golfing buddies use for their phones, and this is what I think not rich old golf people use for their phones. So it's not quite as like scientifically rigorous, but you could probably
What you need a signal on, though, is like, when would high wealth individuals stop spending? I mean, poor people spend 100% of their income, whether times are good or bad. That's the nature of being poor, right? You
yes,
don't
can confirm.
save. So wealthy people, though, stop spending in times that are difficult and spend when they feel wealthy.
Yep.
You could probably look at, I mean, honestly, you could just, you want to know when wealthy people stop spending money, look at real estate and the stock market, just in general.
Yeah.
Right? But I mean, again, you're getting to the same spot where, I mean, staples outperform in recessions relative to growth because people have to always spend on staples, right? Discretionary items. That's the entire theory behind all of those, is, and that rotation is because of that. It's
yeah. It's a much less tenuous of an idea. But like, as much as I tell people to be smart with their money all of the time, I'm a really, really big fan of like tenuous, seemingly dumb ideas, because they're just so fascinating to me, even if they don't end up working. Like, so far, like, I can't score this strategy highly because like it doesn't actually measure anything. So far, like, in my heart, this is my favorite one. Because it's just such a cool idea. It just doesn't work. Or like, but it does work though. Like, it very clearly works. But I think it works because it's just buying like gigantic profitable companies regardless.
Yes.
So,
either
like,
way, it's buying companies.
Right, exactly. Which, like, we kind of illustrated by just taking all 8 of the companies, taking the check out, and it's like the performance is same, the drawdown is just a little worse. So, like, I can't score it very highly in good conscience, but I love it because it's just such an interesting idea.
No, if you could crack the code of like what it's attempting to do, you're right. It's
But like, that's just it. What it's attempting to do is basically the same idea as the XLK versus XLU, just with different, like, it's trying to not use whole broad market sectors with such simple explanations for why.
I mean, I don't think it's really similar at all, except perhaps in an abstract sense. Like XLK versus XLU in a flight to safety during, say, a recession.
Right.
That makes perfect sense. The volatility of two companies with like some overlap in their business, but
but not 100%.
Right. Because
Probably not
AT&T is also a media company. I don't know, like, I don't know what that even means.
Yeah. okay, so like the standard deviation check, like it doesn't make any sense at all. But like that's just part of the appeal to me. Like it's actually just noise that happens to work out, and it's I don't know, man. I have a soft spot.
I think
for, like,
that particular phrase
groping
describes
weirdness.
so many of our strategies.
It's actually just noise, but it works.
It's actually just noise.
Well, either group of 4 outperforms Spy all by
Oh,
itself.
sure. Yeah,
Well,
yeah.
because you're
By a
buying,
lot.
Like, you're picking 3 out of the 25 largest companies in the country. Actually, I don't know if AMD is in the top 25. I don't know. Top half of the S&P 500. Like you could probably take 4 companies out of the top half of the S&P 500 and plug them in and probably get comparable results. Actually, no. That's not correct. The Magnificent Seven have been like on an absolute fucking tear this year. Never mind. Forget I said that. That was stupid.
Yeah, but
because that's wrong.
Let's see. Google, Meta, Walmart, TQQs. Again, like I just am running a random period here. I mean, they outperform Spy by a lot. I'm actually curious which part is, and where is it getting its returns here? Google? No, not even Google. Meta? No.
So you did buy X, okay. Heavy Tech. Did buy bonds. So bonds are up and market is also bullish. Do that. If bonds are up, market isn't bullish. No dip, bonds. Interesting.
I mean, you're also better off just holding TQQs than the baskets of Google, Meta, Walmart, and TQQs.
That doesn't surprise me. That doesn't really surprise me.
Although you get an 80% drawdown.
Right. Yeah, that's an obvious, not ideal point.
But if you just run those 4 together, you're still getting a 56% drawdown.
56 is a smaller number than 80.
This is true.
Like, I couldn't handle either, but empirically speaking, that's actually a good point, Derek. Let's see what it does with RSI. Because I haven't spent enough time fucking around with this strategy. RSI 14. RSI 14. Let's see. Alright, so we got 34 and that's 37.6. Nope, that's worse. Oh, I want this to work so badly. But it doesn't. Alright. I'm going to finalize my non-expert opinion on this as it's basically just noise that happens to do something every once in a while. And then we're going to go on to this thing. This monstrosity. Okay, July 3rd, 2023. We have the second shortest backtest. Started on that Saturday. All right. Annualized return of 4,429. Okay. Okay. Let's see what we got. I'm very surprised that he didn't. I'm very surprised that he didn't enter this under its new name.
I think they're different.
Are they really? So you're telling me this isn't the same thing as YOLO Fuck Rocket? Damn. Well. Okay. So we got moving average of Beto greater than the 200-day moving average of Beto. 30-day max drawdown of Beto is greater than 10%. Else.
It's entirely in the 3-day moving average of return top one. All of the return, it doesn't ever get in
Into
the
that.
30-day max drawdown of Bitto greater than 10%.
Well, it's because
So
over the very short time period this has been
Yes.
Yes.
back tested.
Right.
Bitcoin's been doing quite well.
Right.
So everything is driven off 3-day moving average of return top one of all of those, which it's really getting Mara and Coin and all the things that are up 500%.
Yeah. Yeah, exactly. So that's how we're hitting a 4,000% cumulative return with this thing.
Yeah, I think Mara's up like 500%, right, in the last month.
Sounds about right. Beto is what? 2x leveraged? ProShares Bitcoin strategy. Okay, so it's not even just Bitcoin. It's like...
But it's been in Mara for the last,
is
whatever,
Beto?
7 days,
Okay.
then BITF.
I am going to
Okay.
see if I can... the 50-day over the 200 of Beto. I'm going to see what kind of correlation there is. Let's get rid of T because that's irrelevant. And we're not looking at the EMAs, we're looking at SMAs. SMA. Ribbon. There we are. Okay.
Is there any short in those? No, the hodl is all long.
Yeah, Biddy is, I think, the oldest short one.
They're both
Okay.
all long.
But the market has been under. The 50-day has been under the 200-day.
Uh-huh. Yeah.
Because it just has. When was it under?
Yeah, but like the 50 may have been under the 200.
But some stuff was still moving up.
Okay, so the let's make these colors actually different. So we got blue.
How is that even possible?
Dark
How can
green.
you have the 50-day under the 200-day without having a 30-day drawdown of 10%? It's interesting. Because it never went into short Bitcoin.
Never?
No.
I'll take your word for it.
Nope. Never.
So realistically,
So-
we're only looking at the last
Yeah, not very
4
long.
months. So
But somehow it did have the 50-day under the 200-day without having a drawdown, 30-day drawdown of 10%.
So we're
How
looking
is-
at from there, roughly. So the red line's the 200, blue line's the 50. Unless 29. Okay, so unless 3176, 31,764 down to 24, unless that's over 10%, it never would have had a chance to short in the time that it's been running.
Did it? Well, I mean, that is more than 10%, but it.
Okay, well, it probably should have shorted then. But that also isn't. That also isn't BITO. It's just
July
Bitcoin.
3rd.
And I don't actually know what BITO is measuring.
Well,
if I'm being
July.
perfectly honest.
So it's got to be the 50-day is under the 200, and the 30-day at the point where the 50 is under the 300, 200 is 10%, right? So
Believe so.
when the blue line went under the right was September of 23. Why didn't that? Oh, probably because
Okay.
if you look at 30 days from right there, it was flat. It just the 50-day went under the 200, but the drawdown it didn't happen in that 30-day period. It happened prior.
The max drawdown from there is basically like that to that.
Yes.
Which.
So that wasn't more than 10%, obviously.
Right. Yeah. No, that's like not 10%. Good point. Okay, so it never would have shorted. So it just stayed balls to the wall long Bitcoin the whole time. Lit. Love it.
Yeah. I'm excited when I get to actually put money back to work in January, because I will be running one of these, little YOLO rocket. That's going to happen just because. As long as somehow I'm hoping Bitcoin like crashes over the next 30 days and then get in.
Just to see what happens.
Yeah, I don't want to get
Just
in
to test
now.
the logic.
I don't want to get in at 500% gains in a month. I don't want to be in.
I mean, based off this chart, like, because like this is the all-time chart of Bitcoin. So like, you got, oh, that's the 2020 bull run. That's not even the 2017 bull run. Okay, so like, this is the first bull run that I participated in, and you've got. Okay, where's the log chart? I gotta turn this on log because
we'd have to ask him. This. I mean, what is Marathon Digital? What do they even own?
It's a miner.
I don't even know.
They're miners.
They're miners?
Yeah, Mara and Riot are both miners.
Okay. So most of the gains, right, have come from, well, Mara and Coinbase and Riot.
Yeah, for right now, right? Yeah.
Well, it's only right. It's only been and whatever MSTR micro. Is that?
So MicroStrategies is essentially a consultation company that has taken their entire cash holdings and put it into Bitcoin. They are by proxy a Bitcoin ETF that just happens to actually be a business.
Right.
Yeah. Yeah. Okay, so like the very interesting thing about this strategy is that it is basically just long Bitcoin all the time. Just all the time.
Well,
except for very specific circumstances. Very specific circumstances. Like the only time that you get to short Bitcoin is when the blue line is below the red line. And that
the 30-day
very often.
Well, and there's a drawdown in the last 30 days
of over 10%. Yep. So like all that, you can start potentially shorting it right here. And then you have 30 days
Yeah.
About that. And
So it probably would be short, but it
but
might be
then it
short.
would
Right?
almost
The market
immediately go
bounces.
right back up. Which is very funny.
Yeah.
So honestly, personally, I would probably just replace its ability to short with Bill. Personally. Like, there are times where it would be able to work. Like, it'd catch some part of this, and then, like, once you get to about here, it would probably not be able to be in it anymore. So what's 30 days? You figure, like, that.
I'm curious. Why can't we just real quick? I'm gonna just use Bido and Biddy with this logic all by its lonesome.
You could, I think.
So you can still only get it back to August of 22.
Yeah, which is
But
still, like,
so August of 22. I don't know what date, whatever. Okay. So in the max time that this logic can run just using Bido and Biddy, annualized return, it's up 154%. So what was in the first date that you can even run this was August 5th, 2022. And we're up 154% just with this logic. And it never goes into Biddy.
Well, you could tighten up the the numbers a bit, like make the back start on 5% or the.
Yeah, I guess I'm just
shorter.
The logic as constructed, to Vox's point, it never actually goes short.
Right.
It's been long Bitcoin since August of 22.
Which wasn't a terrible position to be taking, because like, just look at the chart. August of 22 is like, you said August 5th, right? That's like right there. I mean, you could have got like, actually no, so like 23 to 15, that's like almost a 50% drawdown. That's kind of a lot.
Yeah, but it's not. But Bido didn't do that.
Yeah, it didn't.
Oh wait,
which is confusing.
Wait. Time out. Never mind. I'm a liar. I have to go into the 22 table. It was in Biddy. It was short from November 8th to December 22nd of 22. And it was short. So it's been short a couple times. It was short from August 5th, 2022 to October 21st. So
looks like it made money on that first one.
So it was short there, and then it was short November 8th, 22 to, like I said, December 22nd, 22.
You said a November 8th to
December 22nd. So it was basically short that whole flat period. It got triggered on that sort of down move right there because it's 50s below and it dropped more than 10%. So 50 was below the 200 and there was a drawdown really as a result of those couple days. But then the market basically stayed flat. So when you look at the equity curve of the logic just with Biddy and Bido, basically from August to January of 23, it was flat, 4%, because it essentially made a little bit. It was up 20% on that first trade, I think. Let's see here. First trade. Yep. First trade made through October. Let's see. Through the 21st of October, it was Up 13%. So it made 13% in that first short, and then it went long and actually went up a little bit, and then it went down and dropped all the way back down 20%, and then it has been long ever since, essentially, and made money all of 23. It's been long Bitcoin. Okay,
All right.
cool, fun. So if you want to be long Bitcoin, this is your jam. Like I said, I'm excited for next year. I want to try it.
All right. So I'm not if you can't figure out how to just buy Bitcoin,
What did Bitcoin do in 23? All by itself. I'm actually because you can't
that was
run.
that was the chart we were just looking at. So Bitcoin in 23.
Well, I guess from August 5th of 22 till now, does it outperform Bitcoin, right? Because we were August 5th.
I think it does. I actually think it does outperform Bitcoin. So to today, and then we go over. So Bitcoin is currently at 87.7%.
Okay. So it's 2x Bitcoin? Because this is, well, sorry. Again, I'm the logic using Bitto and Biddy
Yeah.
is 2x.
Bitcoin.
Yeah.
Okay.
Which is ProShares. Are they levered?
Bitcoin strategy. Who knows? I certainly don't. I've never actually looked into them, if I'm being perfectly honest.
Bitto ProShares, crypto-linked ETF, does not invest in Bitcoin. It's probably just invested in like MSTR, like you said. Oh, let's see.
Bitcoin futures.
Okay. What is Bitto over that same time period? Actually, I mean, that's really the better gauge. Is
almost exactly the same. Slightly underperformed.
So it's significantly outperformed Bitto.
Uh-huh. Yep. Yeah, it has. And it's significantly outperformed Bitcoin.
And then over the last month, it's significantly outperformed all of the above because of Mara or whatever's going on with that.
I don't know. Last month? That's a great question, actually.
I mean, the last month, it's like a bajillion percent. Trailing 1 month return, 222%. It's funny. Cumulative returns on this 527. It's all the last 3 months, anyways. But basically, all of the gains are the last 3 months since October, mid-October, end of October, basically. From October 23rd is when it gained everything.
Yeah, so we're currently looking at about 17%, roughly, give or take.
Okay.
For Bitcoin.
So yeah.
In the last month.
in the last 1 month.
Yep, the last 30 calendar days.
Okay, so in the last 30 days, this is up 220%.
Yeah. Okay, so like it's really hard to argue with the numbers, so I'm not even going to bother to try. The returns are great. The returns are absolutely fantastic. It has no way to do anything other than go hella long Bitcoin, which
Or derivatives of Bitcoin, which is even better. It's glorious.
exactly, yeah. Okay, yes, technically it can go short. Technically,
Yeah.
because now CQ's here, and like this is great timing on his part, because now he's actually going to have to listen to me tell him that, like, apart from the 3-day moving average of returns, which I don't like, there's no actual issues with the logic here. There's none. So, like, I don't know. It's not really within my personal risk tolerances, but, like, I can't actually tell anybody not to run this. Because, like, it's fine. I don't trust 90% of the things in it to hold, like, for any extended period of time. If you want to be able to just put money in Composer and leave it, don't touch this strategy. But, like, if you're a degenerate that reads Composer every single day multiple times, go for it. You're the target market, honestly. Yes, exactly, 95% of the community. Actually, no, not 95% of the community. Like, what is it? I did the math on this. There's like 100 people that actually communicate more than once a week out of 4,000. So it's like 3% of the community actually is even remotely, like, should even touch this. Oh, God.
Like I said, I'm throwing some money at it. You hit the nail on the head. Some degenerate. I don't like Bitcoin. I'm not a crypto fanboy, but it's kind of hard to argue. Like this is like roulette.
Yes, it is. No, like it is. Like it's
3-day moving average of return is you're spinning the roulette wheel on super highly volatile stuff,
right.
which, for a few $1,000 or something, it's worth. I'll do it. I'm excited. Not gonna lie.
You missed the part where I told people to just buy Bitcoin. Like just buy the Bitcoin. Yeah, dude, it's better.
It dramatically
don't do both.
Buying Bitcoin.
That's not the point.
At least over the last month, it dramatically outperforms buying Bitcoin.
Yes, I understand that. But, like, you guys have heard me say multiple times that the returns of the strategy are, like, the least important thing about the strategy for me, right? Like, we've all heard me say that more than once outside of this call. I don't care what the returns are. I don't. Like, I don't give a shit. Like, it's great that it's up 200%. Like, I'm happy for you. It takes less time to prove sharp. Like, okay, yeah, sure, but, like, you have one bad day holding Mara when they say that they're, like, diluting their shares and you're down 30% in like a day. Okay, but then you lose 30% of that 500. Right, yes, that's my point. So you go from up... Okay.
So my argument for actually running this for the past week is just considering where we are in the Bitcoin hype cycle, going completely crazy with a long position, at least in the short term, makes sense. But yeah,
right.
even then,
right.
I can't bring myself to run this on its own with going 100% in just Mara?
No, CQ, this doesn't last forever. It doesn't. It just flat out doesn't. Like, okay, so the... yeah, no, it just doesn't. Like, it doesn't last forever. 'Cause,
I
like,
am curious.
What's that? Go ahead.
I was going to say the logic, though, the 50 over 200, 30-day max, and that, like, if you just do bid overs biddy, it outperforms the underlying. And the logic does outperform the underlying
Yes.
buy and hold strategy over, whatever that is, 16 months.
Yes. Yep.
Now, using derivatives of bid-o and biddy, right, becomes
Or miners and like...
and using 3-day moving average of returns, is that sustainable? Who knows? But it's
but like the question is like we have no way of knowing that because the back test is like literally 3 months. Like,
well,
there is no question about sustainability because we can't answer it.
100% of the return,
but there is no answer.
Came in the last not very long. But if you
complexity,
the Bitcoin hype cycle,
right? Exactly.
Yeah, I think
like
because
because
the hype cycle and
go for
and
it. It's about as simple as it gets. The things in it are not simple because like what the fuck does BITO even do? Like what is it? Simplicity, I don't know. Like let's give it a 7 because the logic's really fucking simple, but the things that it's holding are not simple.
yeah, CQ's technically right. I mean, if it only worked for a quarter of a year or 1 in 4 years,
right?
And you're beating, just like holding Eli Lilly and Nvidia.
Yes.
I mean,
yes.
Okay.
Okay. So this is the part that he's going to love. If you keep your position small. God, I have to close the fucking chat. I can't even read this anymore. I don't want to hear what the fuck he's saying. If you keep the position small and you are perfectly cognizant of the fact that whatever amount of money you have gotten it up to, there is a non-zero chance that 50% of it just evaporates overnight because like a miner decides to dilute their shares or some shit, which wouldn't be the first time that's happened, and it won't be the last. So long as you are very, very aware of the risks that you are taking and you keep your position size appropriate for what you as an investor can handle, the logic of the strategy is sound. I'd probably replace Biddy with Bill just because I don't like the idea of trying to short Bitcoin, but it's probably fine.
What? Why can't? Where's the chat? Why do I not know how to do any of this? Where's the chat? Are people chatting?
Yeah. So there is a text chat associated with the voice chat. So I don't know if you're on mobile or what, but
I'm on my laptop and the iPad.
So if you go up to the top right on the desktop version, there's a little bubble.
Yeah.
Click
there
on that
or
bubble.
right next to the actual channel. It's actually in the side panel as well.
Do I have to go read this wall of text now? Jesus
Oh,
Christ,
there it
there's
is.
an actual fucking wall of text now.
Open chat.
CQ, you text like my girlfriend.
Oh my God, there's a lot of messages. Wow. Okay.
I guess I didn't really help by posting that image in the chat itself that you can't find.
Okay, fine. You type. Whatever. You know what I mean. You type like my girlfriend. Single words at a time.
Okay.
Okay. Found it.
I'm sure you do get thank you notes from randos, but like, do those randos know that like mining companies routinely dilute their shit on like a regular basis? Yes, you're absolutely correct. 4,000% AR appeals to literally everyone. You are 100% right. But like, the problem with that is that that's like that's exactly what happened with beta ballers. It appeals to everyone, and then like nobody considered the risks or the things that could go wrong. So like,
Yeah, everyone likes 4,000% if it works.
Right, but it's not really 4,000%. It's taking this recent explosion and then
Yes,
trying to
multiply.
annualize it.
Annualize
Yeah.
it.
Here.
Okay,
Yeah.
I'll take 500%.
Yeah. Let's be.
in the last 90 days. I like that.
Yeah, it actually, on its own, climbed me out of the hole I found myself in after the yin apocalypse.
Yeah, Yin, that can kiss my ass.
What am I gonna give it? I'm gonna put like a dude. It's like a 50 over a 200. Like that's not. I don't know. Like, let's give it like a 4 for originality because it's not great. Like it's very generic, but it works.
I think, wouldn't a 4 be like just buy Bitcoin as a strategy? I mean, at least this is.
If its overall rating was a 4, but like I'm
This
going
is
off
like
of originality.
Take the fastest moving thing in the entire Bitcoin ecosystem.
Yeah.
Or every
that's
now
exactly
and then
what he's
maybe
doing.
short.
Like he just
Yeah.
like okay, correct me if I'm wrong, CQ, but you basically took like most of the like Bitcoin associated tickers on the stock market and just threw them in a sort, right? Yeah, okay, that's like what I thought. The one that did which one did 60 in 3 days?
What is ARBK? Is that the BlackRock one? I thought that was.
Arbok? Blockchain tech. No. I thought it was a Pokemon. Damn. Missing the forest for the trees. I don't know if I'm missing the forest for the trees or if I just think the trees are more important than the forest. Because like we've had this conversation before, man. You know how I look at things is differently than you look at this.
Yeah, there are also forest fires, right?
Yes. I mean, forest fires are not really an unfortunate thing. Like, their effects on humanity are, but, like, before people went and built things in places, forest fires are the way things grow. Like,
Well, in part because
yeah.
of evolution.
Well,
taking
that
advantage
too.
of
forest-
that,
a forest fire is fine as long as it doesn't burn you into ashes, right? That's kind of
Right.
the
But, like, that's what
problem
I mean.
with the fire.
So, like, the problem with the fire isn't the fact that it destroys things, because the destruction is, like, part of the process. So, like, okay, so I don't know about you guys. Like, I don't know how the forests work around you, but, like, fun fact, half my family is in, like, the forest fire service where I'm from. So, like, I'm, like, intimately familiar with these things and this metaphor, because it's, like, actually extremely accurate. The very specific species of pine tree that is the dominant tree that makes up the forests around where my family is from requires fire in order for their cones to even open. So new trees won't grow until there is a fire. So, like, the entire cycle of life in the forests where I'm from is entirely dependent on the fact that the forest itself will burn down at some point.
Yeah. So I think
Yeah.
that's why CQ says buy Bitcoin.
Yes, that is why CQ says buy Bitcoin. But like, that's the funny thing. I also say buy Bitcoin, but I don't say like just buy Bitcoin and hold it fucking forever. Because like that's probably a better idea than this. But I'm gonna be honest, like the short is actually one of my least favorite parts about that. Like I honestly think you should just put it in bill. Like I would rather just not be in the market at that point. This is the vanilla. You have very different standards for vanilla than me. Okay. It's a 50/20. It's like I can't give it originality. Like single ticker days. Like it's single companies. Nah, it's like a 50/50 split of like indexes. Backtest, it's gonna get a 3 because it's slightly longer than the yield max strategy was. Slightly longer than the yield max strategy. Would I run it? Would I run this strategy? I mean, yeah, like I'm a degenerate at heart, so like yes, I would run it, but like it'd cap it out at what, like 5% of whatever I have in Composer?
That's more aggressive than I would have thought you'd say.
Oh no, so like this is the thing, like I'm actually like not going to be moving my entire net worth to Composer, like at any point. That's just not happening. Because like there are too many companies that I want to just buy and hold for like the rest of eternity. And I can't do that on Composer. So like I don't want to sell my portfolio of like Microsoft and
You
all that.
can buy and hold forever on Composer.
But why would I?
Yeah,
When I
then you're
already
also
have the
then-
portfolio on Fidelity all set up.
Right. And then
No,
you'd be
fair.
forever trapped in Composer.
Well, not forever, but
Or, but you have no way to move that portfolio out. You have to sell.
yeah, that too, yeah. You can't ACH transfer out, can you?
Mm-mm.
Bias against the asset class. Sir, before you got here, I'm the one that argues against all the boomers who don't like Bitcoin. Like me, before you got here, me and Deez were the two most pro-Bitcoin people in the server. Like, I just don't think that, I don't know, like a decent chunk of the people here looking at strategies can actually handle the volatility of it. Like, yeah. Because, like, that's the thing. Like, for some reason, people seem to listen to me when I say things. I don't fucking know why, but they do. I mean, fair, yeah, what they do with their money isn't my problem either, but, like, I'm going to inform them accurately. I'm not going to lie to them. Like, I'm going to tell them, yeah, hey, look, it's volatile as shit. Like, it's volatile as shit, but if it works, it works. Like, can you handle the volatility? Yes, no. Most of the time the answer is yes, and they're lying, and they can't actually handle the volatility. But, like, I don't know. I don't know. Yeah, I'd run it, but, like, not with a ton of money, because, like, I don't want to watch 50% of my money just, like, evaporate one day. That doesn't sound fun. You're right. It technically might not happen.
But it has happened multiple times in the past with Bitcoin.
I'm not even talking about Bitcoin. Like, I'm talking about, like, hold on, let me see if I can find that on the chart. Because, like, there have been multiple times where, like, Riot has announced that they're selling shares and, like, their shit just goes down, like, fucking... let's see.
I mean, it has come back.
Oh, it absolutely has. I'm not denying that. Not denying that at all.
No, I'm referring to what CQ's saying.
Oh.
I mean, so some of us remember when Bitcoin crashed down to pennies. From when it hit, it had been at $1,000. That was the Mt. Gox crash. Yeah.
Oh, yeah. Shit, yeah.
But literally down to pennies. Now, it was a different market. It was very centralized on one exchange.
When was that?
Coinbase
That was like 2014, right?
Ish, yeah.
2012, 2014?
Something like that. It's possible, yeah. If the SEC, well, I guess they have approved it, kind of. Gensler's been, I don't know, he's been doing some weird stuff with.
Don't let Guzzler hear you say that. They haven't approved shit yet, and he will make sure that you know that.
Yeah.
Okay, so I don't think it was actually $1,000 to pennies.
I'm pretty sure it was.
I mean, when you say pennies, do you literally mean pennies, or do you just mean?
I mean, it was literally trading for pennies. It was under $1.
Interesting. I mean, it might have been like a.
It was a buying opportunity, but a lot of people just threw up their hands. But a lot of people also just couldn't sell because their Bitcoin was trapped in Mt. Gox.
Yeah, truly sad times for those people. Except yes, because they probably still don't have their Bitcoin.
Still don't. Yeah. Supposedly that's happening soon-ish.
Allegedly.
So I have PTSD about Bitcoin drops like that because I was there, and I'm still waiting for my Mt. Gox payout.
Thankfully, that was like slightly before I got involved. Slightly. Or at least involved seriously, I should say.
Yeah, we're getting far less than 50% out of Mt. Gox.
Oh, he had his money stuck in Gemini Earn? Because regular Gemini is fine. Earn was the fucked part. Rip. That's ass. Yeah, okay. Alright, yeah. CQ, I would in fact run your strategy at a very, very small percentage of my portfolio. Thank you, Captain. Okay. On to the next. CQ. Happy holidays. Okay. Holiday competition. Use the top heavy triple Q against its equal split version to determine the movement of mega caps. And use Bill as a semi-canary to determine rates. Ideally, you catch more upside of mega caps when they are rolling, and less downside when they aren't. Should be all new logic, not optimized at all. Perfect. Love it. Wow, that's incredibly simple. It's like 2 checks and 3 baskets. Cool. That's nifty. Okay. Okay. So we got the 20-day moving average of triple Q greater than the 20 of triple QE. So when the Magnificent Seven are outperforming everything else, we go into leverage. That's weird. Why are we leverage and then slightly less leverage and then strange choice, but okay.
Yeah, this is that bill check doesn't really help.
No? Which
No.
one's the bill check? Second 365 cumulative return of bill greater than or equal to 175.
If you actually just put the offensive light in like if the 20-day Qs is whatever less than the QQQE, it's better by all measures.
Interesting. Well, like you said, it's not optimized. So I guess cut it some slack for that.
Yeah.
How far back does it go? Now I'm curious about this.
Long ways.
Yeah, because what is it? FCHD, VU, Bill, 2017. Crank that bitch back to 2011. Okay.
Like end of 13.
Yeah. Alright, so let's start at January 1st, 2014. Okay. Alright, so we got a massive max drawdown. Last 3 months are trailing SPY. Last 1 month is trailing SPY. Annualized is 16. Sharp, max drawdown, Kalmar. Okay. So the stats aren't that great. But, there is something here, though. There has to be something here. I don't know how often it's going to trigger. Microsoft, Apple, NVIDIA, QLD, TQQQ.
Good question. What do these just do on their own?
Yeah, that's kind of my next question, is how often does this block trigger on its own?
You actually are better off just running Microsoft, Apple, NVIDIA, QLD, TQQs.
Until 2023, at least. Okay, but this was kind of my thought. So you can Okay, so I'm convinced that this top level check is a good check because I have had the thought of doing the exact same thing, but with SPY instead of the NASDAQ, which in theory it should work for both. It might work better for the Qs, but we'll do the Qs for now because that's what's in front of us. So I want to get a list of the entire NASDAQ 100 nice to invest education companies all. This is not a useful format for me. Give me a CSV. Where is it?
What are you trying to get?
A CSV of all the companies in the NASDAQ 100. Like, that has to exist, right? What is it? Overview? Fact sheet? Ah, you motherfucker.
I found it.
Is it in a linkable format?
Yep. Here we go.
Thank you. Okay. So this is organized by market cap. Cool. Okay. So here's what we're going to do. No. No. Okay. Bro, leave me alone. Stop it. So this is what happens when you're not actually a paying customer. When you're not a paying customer for Composers, they just harass you constantly to link your bank account. This is sound business advice. No, that's not the tickers. the tickers. 60-day standard deviation of returns? That's not what I asked you to do.
Then you just gotta hit back test.
Ah, okay. Can you tell I've never actually used this before? Case. 60-day standard deviation. Let's go with moving average returns. 20 trading days in a month. There's 25, so we're going to go with the top 10. Interesting. That's worse. Okay. RSI. 10-day RSI. Select top 10. Run. 839. Interesting. Okay. So that does not seem to work nearly as well as I'd hoped it would. 20-day moving average of triple Q is greater than the 25 of everything else. I suppose in order to actually figure this out properly, we would need to I suppose we need to figure out if it actually signals anything about the overall market more so than just the companies within the triple Q. Jesus, we've been at this for 4 fucking hours? God damn it. Okay. That explains why my head hurts so much. Why it's getting hard to think. Okay, so... Oh, what the fuck? Okay. So it does great for the last year. When Magnificent Seven were absolutely spiking. And it hits the drawdown that everything else hit, and then it went right back up again just like everything else. Okay. So it's performing exactly how I would have expected it to perform over the last year. And it looks like it performs exactly how I would have expected it to perform in the entire decade-long zero interest rate fueled bull market, and then through the bear market, it didn't do shit. Okay. I like this. I don't think this is an effective bear market check. I don't think it's an effective bear market check. The basket itself is fine. I really like that though. I really like it because it very clearly does. Well, actually, no. Does it? Okay. Before I say that, let's. Let's just make that not actually a sort function. Okay, and it becomes significantly less interesting when you throw companies in there that you don't know just work quite as well. Well, there's a little bit of a difference there now. Six 24, 2014. Yeah, it still just barely matches SPY. And
Yeah, I mean, one of the issues with doing like, market cap weighted versus equal weighted is going defensive because equal weighted is outperforming doesn't mean the large market caps aren't outperforming the defensive position, right?
Yeah.
It's, I mean, the QQQ and the equal weight can both be moving up much better than the defensive positions, which is what
Yes.
I think is happening here, right? Like,
Yeah.
you,
I would agree.
yeah, you don't necessarily like. I guess I would, if I'm wanting to split between like an aggressive position and a defensive position, I want it to be because, right, like the defensive position is outperforming the aggressive position. I don't necessarily want to flip to defensive if the aggressive is still going to outperform the defensive.
No, I get it.
Yeah. I was actually playing around with this lot, like this idea of comparing the Qs to the equal weight, but flipping between like essentially the same thing, but flipping between small cap tech and mega cap tech. So like if the equal weight was outperforming, go to
Like the
small
Russell.
cap tech. Well, no, stay in tech. I mean, again, I guess it was, like it depends on what, like if you're just saying like mega cap is outperforming small cap tech, because these are still whatever NASDAQ Qs,
Yes.
like I get a little nervous if you're using, to jump into like, whatever commodities because mega cap equal weight tech is outperforming mega cap tech.
Yeah.
Like doesn't necessarily say anything about you know, I think I normally want to see things that make, logical sense. Like, yeah, if mega cap is outperforming small cap, stay in mega cap. It's, of the sector. But if, small cap in the sector is outperforming mega cap, which you don't really get to do often because
No.
it's only it's almost the equal weight versus the market cap of the same sector, which the Q kind of give you.
Mm-hmm.
I don't know. There's not very many that you can actually do this with where you can compare an equal weight. It's not that the Qs are only tech, but
It's an
pretty heavy
overwhelming.
tech weighted.
Yeah, it's a pretty heavy bias.
Yeah.
But at the same time, there is stuff like CSX and like Honeywell
Yeah.
and Pepsi for some reason, which I didn't actually know. Pepsi is in the NASDAQ, which is very surprising to me. But the overwhelming majority is tech of some kind. Walgreens is in the NASDAQ. Do you guys ever just like look through the fucking
This is a
constituents of these
stupid question.
indexes?
I was just gonna say, is the QQQ market cap? It's the largest 100 non-financial. Oh, that's the QQQE. Is the largest 100 non-financial companies.
Yeah, so like not banks, not insurance companies, not mortgage providers.
And not, well, anything on the NASDAQ, top 100 non-financial, which does mean you could get, let's see, healthcare, information technology makes up 50%.
Yep, just about. And then consumer discretionary is probably going to make up
Of
another,
QQQE.
Yeah. Oh, E.
So, what is QQQ rating?
Oh, GE spun off their healthcare technologies into a separate ticker. Interesting. Electric, Paychex, Kraft Heinz, Old Dominion, Fortinet, Keurig, Dr. Pepper, Ross, Copart.
Well, so Invesco QQQ has actually underperformed the NASDAQ 100 index.
Interesting.
So QQQ is 100 companies. Top 10: Apple, Microsoft, Amazon, Broadcom, Meta, Tesla, Nvidia, Alphabet, Costco.
Yep.
So the Qs is 57% tech, 18% consumer discretionary. So it's, I guess, similar sector weightings, just more heavily weighted to the mega caps.
Smaller, like, yeah, so QQQE is going to be, it's going to have more of the smaller stuff. So, like, let's drag.
Yeah, it's 100.
Over here. So, like, it's going to have less of, like, Apple, Microsoft, Broadcom, and it's going to have more of, like,
Apple's 10% of the Qs, but only 1% of QQQE.
Right, exactly. Meanwhile, everything that you see that is below the 1% line is going to have more. Sometimes, like, and it's going to have twice as much more, or twice as much once you get down to about 47. So it's got 2 to 5 times as much of these guys.
Mhm.
Like, I am dead set convinced that I can do something with this signal that doesn't have to involve single companies. I just can't do it right now because I'm tired and my head hurts and I need to go to sleep. But I am going to, at some point in time, sit down and mess with this because there has to be something here. Because I know that there's something here. Even if it only fires every once in a while. Because, like, if you look at this chart for the strategy, like, fix the issues. Oh, yeah, that's missing a whole chunk. That might be helpful to have in there. So, like, you can clearly see that there are periods where it just, like, massively outperforms everything else. And, except XLK, because XLK just goes forever. But, like, it might literally just be that, where it's like, when the triple Qs are outperforming triple QE, go into tech, and when it's not, just go into the Qs. Yeah, actually, let's.
Yeah, that's what I was just doing. Like,
Yeah.
if you just do QQQ versus QQQE, you underperform the Qs.
Really?
Yeah. Well,
Do you even, like, cut the drawdown at all? Yeah, the drawdown's worse. The heck? Interesting.
Clicking back in, damn, you guys still on this, huh?
Yes.
Where you at, number 3?
7.
Okay.
7.
I like the dedication.
I am not making it through this whole list tonight. There is no shot. We're picking this up again some other day. Okay. There has to be something here, though. I know there is something here. Even if there's not, I will force there to be something here.
I will force. Did you say I will force something to be?
Yes.
I like it.
Okay, so it's relatively simplistic. It is, in my opinion, very original because I have not seen this kind of tech, this kind of check done before. I've theorized it, but
Yeah, the one that I built was the tech rotator combo that actually has. I have a, like, you'd have to look it up, but there's a big tech rotator, and then there's a, because I was working with CQ for a little bit, and he had like the IT rotator, and I kind of did a spin off on that, and I had, so there's the big tech rotator, which is like these, Magnificent Seven, and then an IT rotator, which was using like the rest. But there's the tech rotator combo, actually, I think is what it's called, that I built, that is trying to play with this triple Qs versus the equal weight.
yeah. Okay, fair enough. So it's not the first time
Yeah.
it's been done, but it's the first time
No,
I've seen it.
But there's not very many. I haven't seen anybody else ever do it.
Okay.
Like, it is pretty
Fair enough.
unique. Yeah.
Okay, so I think the lowest number of tickers that it goes into is like 3 at any given time. Yeah. It's like 3, which is solid. I like that.
Mm.
But brownie points for that. Yes, unfortunately, there are a shitload of single companies, and it seems like that's most of the reason that it works. And the back test goes back to 2014. It's decent. 7. Would I run it? Not in current form, but main signal is interesting for further testing. Okay, then what do we got? 1, 2, 3, 4, 5 more. Okay. So there's actually 6 more. There's 6 more. I need to go. I have to respond to that DM, but I also need to. Where is it? Okay. So we're taking that list. And so we're at 7. We're going 3, 4, 5, 6. Okay. So next time we do this, we're doing the next like 3 or 4. This is gonna take us a while, because this is gonna take fucking forever. Okay, I'm calling it here. You're right, I could give them a cursory look, but I'd rather just give them all the attention that they deserve. And if I split this up, it means me and Jason would actually be able to judge them and finish at the same time, which would be ideal.
Something tells me Jason probably spent slightly less time on each one than you have.
Absolutely, yes. I'd be willing to bet you that is almost definitely what happened. There's probably like 3 on this list that he actually like seriously looked at, as opposed to giving almost everyone 45 minutes like I have.
No, this is actually really. I appreciate you doing this. I know you sort of got volunteered to be a judge in this, and
I volunteered myself for it. Trust me, if I didn't want to be doing it, I wouldn't be.
I really appreciate you doing it, and it's actually this is like really cool to go through all these and kind of spend the time to pull them apart and like try and run them different ways and test them and tweak them and
like see what is actually like making them all tick, if there is anything making them all tick.
Yeah.
But yeah, no, I agree. This is a good time. It's going to be fairly productive too, because there's definitely things that we can get out of it.
And maybe we learn something about standard deviation signal.
Maybe. Yeah, you know what my prize is out of all this? More logic for more strategies. That is my prize out of this.
Yeah.
My prize out of this is the same thing that most people's prize out of this, because everyone benefits from this, even if you don't directly win the prize. That's the fun thing about these.
Yeah, I mean, it was why I kind of wanted to sponsor it. I'm more interested in seeing the logic than the symphonies. Like, even CQ's Bitcoin Rally Rider, right? It's like, okay, well, if Bitcoin's moving up, like, some signals work really well in some markets. It's hard to build an entire strategy, but like some of these signals work really well in certain times, and that's what I was really wanting to get out of this whole competition. Was like, is there a different way to look at whatever signal?
Yeah.
And maybe you can like pull them into something else that you hadn't really thought of. So there's some cool stuff.
Agreed. All right, but with that, I'm going to wrap it up for tonight.
Cool.
So I need to go eat dinner, because I haven't done that yet.
Yeah, I skipped it.
It's like midnight. I'm hungry. All right, guys. I will let you all know when I get this video posted on YouTube. I don't know when the next one of these calls is going to be. I'm going to try and talk to Jason and maybe plan the next one a little bit better than this one. Yeah. Thank you all for coming. And thank you, Rogan, for actually starting this whole thing. Alright. I'll see you guys later.
Cool. Thanks, man.
Have a good night, guys.
Later, guys.